I'd say pretty useless dots. Maybe that's a little bit aggressive. That's a personal paraphrase. But is that a baseline assumption by the dollar market?
I think it is some kind of hawkish cut. You'll get guidance for next year, and there will be focus on that guidance, as well as you say, I think there will still be some parsing of the dots, even if you don't think there's a lot of value behind the information
I think the scenario is there for them to become less valuable over time.
Well, I literally asked this to Claudia Sahm, and she was like, they're always kind of useless, but this time around they're even more useless because the Fed isn't necessarily baking in every fiscal assumption into them.
Well, I mean, I think it just shows you a policy direction, right? We're going to get fewer cuts in 2025 in those dots, whether it's 2 or 3 cuts. You know, there could be some short-term feed through to the market in terms of whether that's perceived as being more hawkish or not, but the long-term trajectory is clear. And in 2025, we're going to have higher inflation than we thought previously, and we have elevated inflation now. If you've looked at the last 2 core PCE prints, they're at 0.3% month-on-month. That's not sustainable to get to 2% inflation.
Listen, we've got probably 1 cut and 2 prevarications, one from the Bank of England and one from the BOJ. They got time. They've told us they've got time. I'm just curious, what is the safest and simplest position in this FX market at the moment? Is it to stay short yen for the moment?
I don't think it is. I mean, for the yen, it's more of a medium-term story for us. So we think that they're going to stay on hold in December, but we expect the next hike in January. That's not really the differentiated view. The differentiated view is we expect another hike in July. So that gets you to 0.75%. They've guided towards neutral being 1%. I think certainly the market's not looking for that yet. But as we have inflation come in hotter, so we get inflation out of Japan this week as well, as we have that feed into wages and inflation expectations, you should get more hikes from them eventually. And so while we don't like yen versus the dollar, certainly it's more positive on the crosses, especially if you're worried about hedging or you think maybe you need a safe haven to have in your back pocket. Yen can definitely play that role.
Skylar, really great to have you in this morning. Enjoy the rest of your week and your holidays. That is Skylar Montgomery Koning of Barclays. Okay, coming up, political disruptions around the world from France, Germany, South Korea. We're going to have it for you next in your Bloomberg Brief.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In case you missed it on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared. And China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology. the only daily business show dedicated to tech, right in the middle of the trading action. Every weekday, only on Bloomberg Television. Context changes everything.
It's Bloomberg Brief. Danny Berger, Manus Cranny in New York. France's new Prime Minister, Francois Bayrou, is meeting with far-right leader Marine Le Pen today, kicking off an effort to form a government that can push a budget through a divided parliament. Joining us now is Eleonora Mavroidi of Bloomberg Economics. Eleonora, thank you so much for joining us. So, I mean, it's been political discontent in France. Is Bayrou going to have any more likely success than his predecessor in getting a budget through?
That's a good question. Well, he's definitely going to face the same fragmented and polarized National Assembly as his predecessor, and that would likely limit his ability to implement any big fiscal plans. So the immediate plans right now is the key priority is to form a cabinet that will be more stable than the last one, and that will be able to push the 2025 budget. Timing is running up, so in the meantime, the parliament is likely to approve a special law to let the government, to let the state finance itself. We got more information about what the state law would involve last week, and there are 2 points that pieces of information that are important. That the state council published an opinion that income taxes should not be indexed, and the pension indexation will not be delayed. So under this information, our baseline estimate is that the outcome will be a meaningful austerity, but the deficits will remain wide and will settle at around 5.4% of GDP next year, down from 6.1% in 2024, but slightly up from the 5% plan under Barnier.
Well, Eleonora, the consequence of this discontent, fiscal discontent, has Moody's downgrading the bonds. Now, it's not that there's some sort of precipice moment, but they are concerned. Moody's say there is now a very low probability the next government will sustainably reduce the size of the fiscal deficits beyond next year. How much pressure does this put, again, on these budget negotiations on Le Pen this time around?
It definitely puts some pressure, and Le Pen is going to be discussing today with Prime Minister Bayrou. Overall, we see that this, given that the government will be able to extend the budget of the 2024 budget into next year, we don't see this political gridlock creating a massive economic turmoil in the short term. But still, we have scaled down our forecast for 2025 because there will be some fiscal consolidation required next year, and spreads have widened. As we see in the crisis have widened the spreads, and that could put a drag on the economy that we estimate can be between the range of 0.3 to 0.5% in 2025. And also, even if there is a continuation of last year's accounts, there will be some austerity, and the fiscal situation is such that the next government cannot avoid doing some fiscal efforts next year. Now, there are the longer-term risks, as also the downgrade by Moody has shown, that fiscal sustainability in the long term seems precarious. If the government fails to do any fiscal consolidation from now on, we estimate that would put the debt on a steep upward trajectory and exceed 120% by 2027. But even if we make the assumption that they return to pre-pandemic budgets, that would not be enough to stabilize the debt.
Eleonora, let's see what the negotiations bring. Eleonora Mavroidi joining us from Paris. To Germany, the Chancellor there, Olaf Scholz, faces a vote of no confidence today, which he intends to lose and trigger that snap election in February. Joining me now is Olli Krug. He's outside the Bundestag in Berlin. Olli, good morning to you. How weakened is Scholz in the polls as he goes to this election in January? Because it's been a series of political stumbles all the way along to get here.
Yeah, I mean, he's doing a little bit better than he was at the very beginning of this election campaign, and he's been doing throughout this year, but he's still basically in third place, the SPD, trailing behind the CDU, the center-right, Merkel's traditional party, led by Friedrich Merz this time around, and then also trailing the far right, the AfD, the Alternative for Deutschland, which holds about 20% of the vote, and that is the sort of constellation going into this no-confidence vote that we are going to get that begins basically right behind me at 1 p.m. with Olaf Scholz giving a little speech, 25 minutes followed by 2 hours of debate in the Bundestag before lawmakers, then a sort of roll call vote, and by the end at about 4 p.m. local time, we're going to get the outcome of that vote, and that is likely no confidence in the chancellor and his government, dissolving the government eventually, and then heading to those early elections on February 23rd of next year. We should say that there's only ever been one such snap election called since basically the Berlin Wall fell in 1989, and going into this, we know you were just talking about South Korea and France and Germany. It is basically the budget that has been at the center of all of these political dramas. And so you have this sort of picture here in Europe where you're facing slow to basically no potential recession, and that is putting huge strain on many of the initiatives that are being sort of put forward, and it's creating a huge governability problem, not just in Germany, not just in France, but across Europe at a time when arguably, and you listen to Mario Draghi and other leaders within Europe, you actually need very strong politicians with visionary futures or views of the future to bring together things that can actually change the paradigm for this economy, whether it's the capital markets union, whether it's a banking union, all these sorts of things. They are impossible to put through when you have very, very weak governance, both in Germany and in France, and that is likely what we're going to get here again in Germany. You may get a sort of stronger sort of center-right government, but it's still going to be a coalition, and there's going to be a very sort of fragmented picture here politically.
Oliver, we appreciate it. It will be an interesting next few hours. Oliver Crook there in Berlin. Okay, and in South Korea, the Constitutional Court has begun reviewing President Yoon's impeachment case after the parliament voted to impeach him. Yoon was stripped of his powers after some of his supporters broke rank, giving his opponents the two-thirds majority needed to pass the impeachment bill. Yoon had shocked the nation by briefly imposing martial law earlier this month. Manus.
Danny, let's switch gears back to the U.S. here. We've got President Trump seen over the weekend with, President-elect Trump, I should say, seen over the weekend with his cabinet picks and his closest allies. It was the Army-Navy football game. Senator Lindsey Graham saying that the Defense Secretary nominee, Pete Hegseth, plans to release the woman who accused him of sexual assault from a confidential settlement agreement. We're joined now by Bloomberg's Kayla Gardner. Kayla, not only is this Trump's political capital being spent very, very publicly over the weekend with his picks with Tulsi Gabbard and Hegseth, how important is it that Lindsey Graham talks about Hegseth releasing his accuser from this confidential agreement?
Well, it's potentially huge because we know that senators like Joni Ernst, who has expressed reservations about Hegseth, really wants to see him fully vetted. She says she wants to see a hearing process, and her flipping essentially over the last few weeks here has really been interesting to watch, because originally she suggested that she was not yet ready to support Hegseth, and then we saw this pressure campaign really play out. We saw ads on Fox News by this Elon Musk backed group. We also saw her receive a primary challenge in her own state. She's expected to run for re-election in 2026. So we have seen her drastically shift over the last few days, and I think this is a thread that we could potentially see over some of the other controversial nominees for Trump, whether it's Tulsi Gabbard, whether it's Robert F. Kennedy Jr., who has espoused debunked medical theories and has been nominated for the health secretary position. But we have seen MAGA's base, Trump's base, really willing to go to bat for him when it comes to these nominees. They want him to be able to put people in those positions. And I think something that was interesting over the weekend at this Army-Navy game, Ron DeSantis was at that game, but he was not seen with Donald Trump, and he is someone who has been floated as a potential replacement for Hegseth. So that is something that we were certainly watching, and yet no photos of those two together.
I was going to say, Kayla, at the Army-Navy game, he had these controversial picks with him, Tulsi Gabbard, Hegseth, Kash Patel. Is this Trump digging in his heels, saying that Congress needs to be passing this if he's willing to get these photo ops with these various people?
Yeah, it was interesting because at first he really wasn't willing to throw his weight out there for these picks. And we know that Trump's team did have a conversation with DeSantis in case Hegseth was not confirmed. And yet we saw all of them there this weekend sitting with him in that box. And so to some extent, he is throwing his political capital. But again, these are people who have always been loyal to Trump. So it's not particularly surprising that they were invited, that they were there. He's been adamant about placing people in his administration that he feels as though he can trust.
Well, let's see what happens next over the course of the next coming days. The Israeli Prime Minister Benjamin Netanyahu also spoke with President-elect Trump on Sunday, calling the meeting very warm. The issue here is, of course, I think it's about trying to understand what is the objective for Israel in Syria. You've got Bibi Netanyahu saying one thing, and perhaps this doubling the population pledge. There's nothing new in that, but it's about the action on the ground. And that has brought the air of some of the Middle Eastern nations, hasn't it?
Yeah, it's been really interesting to watch Netanyahu and Trump really have this back and forth. We saw them have multiple interactions over the last few days, whether it was on social media. We also saw Netanyahu's wife traveling to Mar-a-Lago. But these two definitely have a warm relationship. But it certainly draws into question, what incentive does Netanyahu have to continue negotiation with the Biden administration? Blinken was just in the Middle East last week and met with Netanyahu. But we know that Trump and Netanyahu just have a friendlier relationship. And we've seen Trump say that he wants to see a hostage deal by the time that he is inaugurated on January 20th. And he said, quote, that there could be potentially hell to pay if those hostages are not released. So it seems that Trump is going to have a much more assertive attitude towards Israel, really pushing and advocating for the things that they want to see. And we've seen some tension, of course, between President Biden and Netanyahu, who really wants to see better conditions, humanitarian conditions in Gaza.
Akela, we always appreciate it. Thanks for getting up early for us. That is Bloomberg's Akela Gardner. Coming up on the show, it's a big week for central banks, a no confidence vote for Chancellor Scholz. A lot on your agenda. We'll set it on your Bloomberg Brief.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
It's your Bloomberg Brief. Danny Berger and Manish Cranny in New York. Let's get you set up for your trading week this week. German Chancellor Olaf Scholz will submit to a parliamentary vote of confidence today. Then he will be speaking at 7 a.m. Eastern. Then we're going to get 3 central bank decisions within a window of 24 hours. We get the Fed. They announced their decision on Wednesday, 25 basis point cut. Very much so expected. That will be followed by the BOJ and the BOE. All that happens on Thursday, Manus.
Yeah, cuts and prevarication. Some stocks to watch, Danny. Supermicro exiting the NASDAQ 100, said to tap Evercore to help the firm raise a bit of capital. Axon Enterprise rising alongside MicroStrategy and Palantir as they join the NASDAQ 100. And then Broadcom is up 2.33%, raised to outperform CICC. Price target $220. But that really had a Broadcom banging day on Thursday. Danny.
It sure did. Manus, let's leave you with a snapshot of what this bond market is doing, because there is a bid. After we saw yields move higher, biggest move higher in yields since October 2023. But the dollar, maybe the more interesting asset, Skylar Montgomery Koenig saying that it is not yet fully valued and it can go further in 2025.
It's interesting because we got a big call on the Bloomberg terminal this morning that the dollar is near its peak value. It will roll over next year. Yeah. It's stomach churning. What was it? The strength is stomach churningly strong, according to Kijukes.
Yeah. Again, a lot of estimations that the mojo in the dollar will run out. Not so, according to Barclays.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
The
Fed's more than likely to go through neutral to go from a restrictive stance on policy to a stimulative one in the coming year.
But the Fed, a big piece of the caution is they are, to their core, data-driven in their monetary policy. And we know data are messy.
The market looks very convinced that a cut is coming.
Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Starting in the first half of next year, you could see the Fed not explicitly but implicitly start to signal pauses.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance with equity futures on the S&P 500 up by 0.2%, just a little bit of stability. Check out the Nasdaq 100. Your scores look like this, up 0.3%. And check out the bond market. Speaking of stability, a big sell-off at the long end of the yield curve in last week's sessions. The 10-year up by more than 20 basis points. Similar move on a 30. We're down about 1 basis point on a 10-year this morning, 438.29. Your week ahead is stacked, full of data. The data point of the week is U.S. retail sales. The central bank decision of the week is the obvious one. The last full week of trading for 2024, the last Fed decision of the year.
And widely expected to be 25 basis points. Welcome back. It's good to see you.
It's good to be back,
We
Rally.
miss you.
You know what it's like, a week away, you struggle with speaking, working out when the show starts, when it finishes, what to say next. It takes a while just to get in the groove.
It started. We've got 3 more hours. I'm sure you'll be fine. I'm honestly really interested to see how the Fed signals into 2025 at a time where everyone is flying blind, including drones. But there's a question here about how much they can signal and how much they're going to take into account some of the potential policies coming from the new White House.
Exactly. When it comes to basically what are they going to say in terms of what the market is pricing in, which is a Trump trade, and how divergent we've seen the Fed be from financial markets. Bill Dudley spoke to us last week, and he talked about how in November, Powell's response was categorical. We don't guess, we don't speculate, we don't assume. And he says this time around, Jay Powell should be more nuanced.
I agree with you both. Federal Reserve is interesting for those reasons. I think there are far more interesting things going on right now that we should be talking about. Terry Haynes of Pangaea is going to join us a little bit later this hour. U.S. telecom networks hacked. Unexplained mysterious drones flying over New Jersey and much of the East Coast. That's 2. 3, the sabotage of telecoms cables in the Baltic. And you put it all together, the backdrop right now, the highest geopolitical risk in, 50 years? We still don't have a clue what is going on worldwide.
And Americans feel like this administration and even Congress as well, which there's no policy really by Congress when it comes to the drones that we've seen a lot of outroar by, especially over New Jersey over the weekend. There's no policy, and they feel like the administration is on the back foot, and they were asking for more answers. We had a weekend, we had officials from the FBI, the Homeland Security come out and have to talk about drones over people's homes, shutting down of airports, and it still doesn't seem to be enough to acquiesce people's concerns.
It's just not adding up. I'm serious. I'm sorry. It is just not adding up. They're not a threat. They're over crucial infrastructure. We're not sure what they are, but they're fine. One thing is not adding up with the other, and that's the reason why people are very concerned about why drones are flying over their homes.
So there's two options here. Either they know and they're lying to us, option 1, or option 2, they don't know, and that's pretty scary.
Basically, this is the reason why, and Terry Haynes raises this, even if there is an explanation that isn't necessarily China or Iran or aliens, it's going to be probably concerning to people who have lost a good degree of trust that we can really protect ourselves from potential spying incidents like Salt Typhoon, which just affected a whole bunch of different Microsoft outlets. Look, people are looking for what black swan is out there that could potentially disrupt this sense of euphoria that has been in markets. Aside from just a tick up in inflation, which last week was a little bit of a soft patch, there is a big question. What is looming that we do not see? And I think this does not help that at all.
Mysterious flying objects over New Jersey weren't on anyone's bingo cards going into year end, but that's where we're at. Equity futures right now on the S&P 500 up by 0.2%. Your lineup this hour looks like this. Steve Chevron of Federated Hermes looking for the rally in the equity market to continue. Terry Haynes of Pangaea policy on mysterious drone sightings along the East Coast, and Sri Kajagovan of Aberdeen on Germany's political future. We begin this hour kicking off the final full trading week of the year, looking ahead to a Fed rate decision on Wednesday. Steve Chevron of Federated remains optimistic on stocks. The combination of accelerating earnings growth and rate cuts is rare and generally positive for equities. I'm pleased to say that Steve joins us now. Steve, good morning.
Good morning.
It's good to see you. The equity market rip is on the Nasdaq. It's on big tech. It's not on the S&P 500. It's certainly not on on the small caps. We've talked a lot about negative breadth. I've been listening to the team over the last week. This was not the bet coming out of the election. So what's gone wrong?
No, I think growth has surprised to the upside since the election. You know, outside of last week's kind of sell-off, the bond market did settle after the election, right? You had that run kind of to 450 on the 10-year, and then that kind of settled back in. But what we think, and we made a move last week in our asset allocation to reflect this, is it's just harder and harder to justify owning non-U.S. developed markets. And I think you've seen capital leave places like Europe, where now you have political instability, not only in France, not only in the U.K., but now you also have Germany. They sit kind of at the forefront, potentially, of tariff risk. Growth has been soft, and so I think you're seeing capital flood in the United States, and it's helping growth. And I think you really saw that last week.
So the risk going into next year, according to Apollo and Torsten Slok, and we'll talk lots about this through the hour. Apollo and Torsten Slok said it's a repeat of 2022. We all remember 2022 was bad for both stocks and bad for bonds. Would you push back against that?
I do. You know, I think this is going to be an interesting week, and I think, you know, Powell, who always likes to surprise us, he may have another surprise in store for 24, and that is, I think the market's gotten a little bit too concerned and hawkish about inflation, right? Inflation has been sticky. It has been a little bit reaccelerant in the last few months, but if you look, it hasn't really broken out of any kind of long-term range. It still appears to be grinding down, and I think you may see a Powell that's a little bit more dovish than what the market's expecting this week, because he does that to us.
Hold on a second.
He does that to us, Lisa.
Yeah, he does this to us. You say he always surprises us. He doesn't surprise us. He outdoves every expectation from the market. You think that's going to be the repeat?
Well, if you look at it, look, the market has priced in a terminal rate here that's somewhere now between 375 and 4. We still think it's between 3 and 350. That's going to take you to 26 to get there. On the dot plots, right, you generally don't see the Fed erase 2 cuts in one dot plot, right? Maybe they pull one in, maybe they push one out. And so you've got a street that, you know, you've got a Fed with 5 cuts between now and the middle of 26 in their dot plots. You've got a street that only has 3 more cuts. Again, I think what you may see him do is deliver the cut in December and then talk about how their rhetoric is really about a reduction in pace, not in a reduction in direction. So we're going to go to once a quarter next year, but you shouldn't expect that we're anywhere near the end of a rate cut cycle.
The backdrop to this is that you push back completely against Torsten Slok's point of view, as John was laying out, that basically we're going to have a very inflationary and potentially stagflationary policy where you get growth slowing on the heels of some of these tariffs, but you don't necessarily have inflation coming in. You actually think it's the opposite, that a lot of Trump's policies are going to be more pro-growth and less inflationary than feared. Why?
Well, a couple of reasons. One, I think when you're talking about a tariff, for example, it can't be both a tax and inflationary. It's got to be one or the other, right? Because if it really is a tax, then there's an offsetting demand piece to it. You also have to take into account that tariff increase is likely going to come in the context of major tax cuts. You have deregulation. You have some shedding of government jobs. Both of those can be either certainly pro-growth, but also disinflationary because they take some costs out of the system. And so I think when you put that package together, what's happening right now in the market is we are underestimating the growth that's going to come from the policies and overestimating the inflation. And I think the Fed would be wise to be patient here, see what actually gets through the sausage-making process of Washington. There's a lot of steps to go between a concept and actual policy. And I think if the Fed were to react in anticipation of that, they may end up being more hawkish than they need to be in an environment where the labor markets are softening some.
So you don't agree with Bill Dudley? They shouldn't assume, and they should say, we're going to wait for the policies to take hold.
I don't see what policy you're going to respond to. Now, if you want to respond to inflation readings being a little bit kind of hotter over the last couple of months and then, you know, decelerating towards a slower pace of cuts, I think that's appropriate. But again, we've talked about the chess versus the checkers. If you look at each one of the policy proposals that are out there, you can look at it and say, well, this is good, or that's bad, or that's inflationary, or that's pro-growth. When you look at it together, we think what you're going to end up with is something that is more pro-growth, somewhat pro-productivity, and that's going to dampen some of the inflation impulses.
Back to Torsten Slok's note and this idea of rising inflation in 2025. He says the risk is a repeat of 2022 where the 60-40 portfolio underperformed significantly. Can you not use 60-40 next year then?
Well, you got to remember who you're asking. I run multi-asset, which has a lot of those portfolios in it. So I categorically disagree with that sentiment. But no, look, I think what you're going to see is that the bond market and parts of the equity market, I think, have now represent opportunities, right? A bond market that's sitting at 430, 440 on the 10-year with expectations of only three cuts next year, I think there's an upside case there. I think you see the same thing in pockets of the equity market. Some of the hysteria around some of the healthcare names, some of the hysteria around some of the staples names. We look at that and say, we're not canceling drug development in the United States. We are not going to make, snack foods illegal. And so if you have value opportunities there as an investor, those are good contrarian plays, and we're willing to take the other side.
Some of those snack foods should be illegal. But
that's besides the point.
I knew you were going to say
Forgive
that.
Forgive me.
Or just use beetroot instead of BHT.
Maybe. You can make these simple changes. AMH, I'm with you. Should we talk about a bond market? Maybe less about that. Let's move at the long end of the curve, 10s and 30s, moves of 25 basis points. What do you think is driving that? Is that the data? Is that the expected policy change? Or is the Fed's easing bust contributing to this move at the long end as well?
I think you're seeing one thing I'd say is I think you're seeing a resurrection of the term premium, right? When you have a $36 trillion debt, you're running deficits at the level that we're running them, and you're not concerned about growth, right? The market's not looking out and saying, I've got an emerging recession on our hands. What you're seeing is that the short end is coming down along with Fed cuts. And we think that a term premium is reestablishing itself at some level. Now, that doesn't explain last week's move, but it does explain this idea that our big view, if you want to think about it in terms of the market, really comes from the yield curve. We expect short rates to come down. We expect long rates to stay right about where they are. And what that means is that shorter duration fixed income, 1 to 3 year fixed, we think is in the sweet spot of total return. Equities have duration, right? Small caps have 30 to 50% of their lending is variable rate bank debt on shorter term rates. You buy value names or dividend payers based on shorter term expectations that are discounted with shorter rates. And that's one of the reasons why, last week notwithstanding, we expect this market's going to broaden out and those shorter duration equities are going to see relief. As long rates stay high, short rates come down. We think that yield curve steepening is probably the big market story of 25.
Bond market this morning, bit stable. Yields lower by 2 basis points on a 10-year. Lisa, down about a basis point on a 30-year. Consensus going into Wednesday is pretty clear. The market's looking for a cut this Wednesday, looking for a skip in January. Morgan Stanley confident about today, cautious about tomorrow. Bank of America, Lisa, cut today, pause tomorrow.
Which is a reason why people are looking at the data, because they're saying they're data dependent, just like the Fed. And the data's been confusing. The headline figure coming in hotter than expected, but everyone pointing to the fact that rent and owner's equivalent rent has come in quite considerably. This idea of what happened last week, though, to me was interesting, because essentially any upside surprise and you get the biggest increase in yields in the 10-year going back to October 2023.
Can we agree on this, that food wrapped in plastic shouldn't be edible after 12 months? Should we agree on that? Well, that maybe it's not food. That should be the definition of food. Yeah. That it should probably
you have an issue
go moldy
with
after
bread
12
that you
months.
can sit out on your counter for 2 months.
I don't think you should be allowed to call it bread if it's still.
What do you think you should
still
call
not
it?
got mold on it after a month.
That's a cracker.
Yes,
that's a cracker.
We should call it a cracker.
That's a cracker.
There we go.
All right, come on.
New rule.
Bread.
If the Europeans are listening, they're thinking probably that's a good idea. Steve's going to see it. Steve Chevron at Federated. They love the regulations and rules over in Europe. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Drone sightings have picked up in recent weeks, starting in New Jersey and spreading throughout the U.S. Northeast. New Jersey Governor Phil Murphy and New York Governor Kathy Hochul are among those demanding a clear explanation from federal officials. Homeland Security Secretary Alejandro Mayorkas told ABC's This Week that there's no evidence of foreign involvement or that they're a national security risk. Bitcoin has reached a new high again on President-elect Donald Trump's support for digital assets and optimism about MicroStrategy's inclusion in the NASDAQ 100. The largest virtual currency rose more than 3% Monday, topping $106,000. MicroStrategy's inclusion in the index is expected to drive up demand for its shares, allowing the company to raise more equity to invest in Bitcoin. Starbucks hired its first ever chief growth officer in China. The executive is tasked with luring back young coffee drinkers. Starbucks China told Bloomberg it will bring tie-ins with entertainment brands and pop culture icons to market itself. Starbucks has struggled as China's economy slows, with cash-strapped diners having been opting for cheaper local brands where coffee can cost a third of that of a Starbucks cup. And that's your brief, John.
Danny, thank you. Retail sales out of China overnight, not good. Not good at all. Up next on the program, a mystery in the skies.
I want to assure the American public that we are on it. We are working in close coordination with state and local authorities, and it is critical that we need from Congress additional authorities to address the drone situation.
How much of the American general public think they are, quote, on it? Then conversation, up next.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equity futures on the S&P a little bit firmer here by 0.1% on the S&P 500. In the bond market, big sell-off last week at the longer end of the curve. In fact, through the curve, 2s, 10s, 30s. Double-digit basis point move. This morning, we're down a basis point or two on a 10-year, 4.38. Under surveillance this morning, a mystery in the skies.
I want to assure the American public that we are on it. We are working in close coordination with state and local authorities, and it is critical, as we all have said for a number of years, that we need from Congress additional authorities to address the drone situation. Our authorities currently are limited, and they are set to expire. We need them extended and expanded.
So here's the latest this morning. Drone sightings in the Northeast picking up in recent weeks. New Jersey Governor Phil Murphy, New York Governor Kathy Hochul demanding a clearer explanation from federal officials. Terry Haynes of Pangea Policy writing, China's ongoing U.S. telecoms hack, the drones mystery, and the weekend incident at U.S. Cyber and Signal Corp's HQ, singly and together, are significant market negatives. Terry joins us now for more. Terry, I'll ask you the question that we posed going into the commercial break. How on it do you think the government is?
I think the government is. The government represents. How about that? That it is not on it at all. You know, whether you've got Admiral Kirby doing his best Kevin Bacon and Animal House impression, you know, all is well. You know, Mayorkas, who told us the border was secure and then it wasn't, now it is, and then it wasn't. You know, and I could go on about the administration, but they have done nothing to reassure people here. And you know, it's the telecom hack is one thing. The you know, for example, but I think that's the most clear and present danger. But
You know, the fact that the government flat out admits it can't do anything about it in the short term is nothing short of astonishing, and not designed to bring confidence to either the public or the markets, that's for sure.
Terry, you're questioning the credibility of the Biden administration, which the Wall Street Journal editorial board does as well this morning, saying that the admin has squandered its credibility to the point that it's rational not to believe what it says. And it goes on to say, remember the Chinese spy balloon when they were trying to court better relations with Beijing, saying, don't look here, it's not that big of a deal. Who has credibility right now in Washington to potentially ease the concerns of Americans, especially those in New Jersey that are seeing drones over critical infrastructure?
You know, I guess I haven't read the Wall Street Journal editorial, but plus one there. Nobody's got credibility, frankly. You know, and pretty much on any subject. You've got, you know, Mayorkas, the clip you played coming in, it reveals a lot. And one of the things that it reveals is that the administration has a bad conception of its own job. This is a guy who runs the Department of Homeland Security. So, you know, doing everything about Homeland Security is the first requisite of the job. And instead, what he wants to say is you know, Congress hasn't given us enough authority. Well, you know, you run the Department of Homeland Security, go make the Homeland secure. And, you know, kind of worry about the niceties later. Maybe Congress will run you in. You know, instead, what they want to do is spend a lot of time pointing fingers and telling people that, you know, it's really not their job, it's somebody else's job. That alone, I think, is a very, very bad sign.
Well, there is no policy by Congress, and there's a lot of finger pointing done now, retrospect, and who should have been doing this. But what policy should Congress actually maybe work on?
To the extent that there are actually holes in jurisdiction, you know, they should make sure that those are federal, make sure that those the military has the ability to do what they need to do, make sure that the National Guard is involved, civilian authorities are involved. But you know, the administration essentially sat around, as you point out, ever since the Chinese balloon, and did nothing about this, did nothing to push anybody on this. And, you know, so I think it fundamentally lies at the feet of the administration to not push Congress to do anything. I mean, look, we've got a continuing resolution that can be passed this week by Congress before they go home. It wouldn't be too much to ask that they could do some of this stuff and put it in that CR as a response. But, you know, is the Biden administration interested in doing that? Is Congress? They're not. I think it's a failure all around.
Terry, there's a larger question here, and I think this is what you're getting at in terms of just a vacuum of power right now in Washington, D.C. How perilous is that vacuum of power at a time where there seem to be some real imminent threats, whether they are acknowledged or not, that seem to be hovering over the psyches of a lot of people in the market, at least?
Yeah, sure, and full marks for the hovering there, by the way. That was good. The interregnum here is very perilous in a lot of different ways. And, you know, what you've got is a situation where the Biden administration professes it's doing things, but in fact isn't, and blaming other people. The incoming Trump administration, meanwhile, says that, according to the incoming National Security Advisor, Waltz, says that they are also on it and that they are coordinating with the Biden administration. You know, my view of this, for what it's worth, is they ought to be taking, they being the Trump people, ought to be taking a much more aggressive view of this. If they can start changing foreign policy, if they can start changing trade policy even before they're in office, they can certainly light a fire under the Biden people and do something about national security even before they get there, and get credit for it, by the way.
Well, Trump is trying to light a fire under it, writing on Truth Social over the weekend. Mystery drone sightings all over the country. Can this really be happening with our government's knowledge? I don't think so. Let the public know now, and otherwise shoot them down. And then there are a series of articles explaining why it's dangerous and illegal to shoot down property that's flying over your house. And I'm just wondering, from your perspective, you know, how this is going to play going into the end of the year. What are you watching for?
Well, I'm watching for any progress on any of the things we just talked about, whether it be the telecom network, which as I say for markets, I think is the most disturbing since markets rely on telecom networks, whether it be the drone thing, whether it be the incident at Cyber Command over the weekend, any of these things. But what I'm looking for is anybody to not make politics out of this, but to make progress on informing the public as to what is actually going on and why it's going on. We're reaching a point here where the public needs reassurance, and it's in the public in this case is being led in part by the skepticism or worse from state governors, many of whom are Democrats who would normally be trying to do what they could to support the Biden administration, but here they're not at all, which alone tells you how alarming this is. So real progress needs to be made on this before the inauguration, and right now I think people are just coming to grips with it, and people who are in decisional perspectives and places are just coming to grips with that, and that's too slow.
Yeah, the time to try and support the Biden administration, long gone. Now, Terry, thank you, sir. Terry Haynes of Pangea Policy. Bramo, I don't think anyone advises private citizens to get on the roofs in New Jersey and attempt to shoot these things down, but I'm with you. The power vacuum right now. We've revisited this every 4 years, and we'll continue to do it every 4 years for the next several decades. The wait until January, late January, to change things out. I'm very critical of politics in Europe, hypercritical of politics in the UK, but there is one thing they do well in the UK. There is an election, there is a change of power, 24 hours later you're out and someone else is in.
It's even more important when you have such animosity between the two parties. So it's not as if everyone can say, kumbaya, we've got things flying up there, let's get together. It seems like you have some people saying shoot them down, other people saying we have this under control while an entire fire, a dumpster fire, goes behind them. So, not exactly reassuring.
Over the weekend, though, you saw Democrats and Republicans speaking from the same tune. Something needs to be done. Amy Klobuchar was on Face the Nation saying you have to register a drone if it's over half a pound. So if they're registered, come out and tell us who these drones belong to.
I imagine they're not, or maybe they are and they're not telling us. I haven't got a clue. The fact that we can't track them, that's a big problem. Up next, Coach Gubberton of Aberdeen. From New York, this is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends. And I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
We're almost there. For many of you, it's like 5 sessions away. We're almost there. Equity futures on the S&P up by a little more than 1/10% on the S&P. On the Nasdaq 100 up by 1/3%. On the S&P, this from Jonathan Krinsky of BTIG. I know you're all citing a similar theme. Every day in December has seen negative S&P 500 breadth so far. The fact of the matter is, coming out of the election, we were looking for a rally to broaden out, looking for the small caps to perform. Small caps are down for 2 weeks. Nasdaq 100 is up for 4. That's the run we've seen on big tech.
A number of measures of bad breath, and I just can't stop thinking of terrible jokes. I'm sorry, you're doing such a good job.
What, taking the D out?
Yeah, obviously. Like, this market has bad breath. You know, it's like, you know, that's been sort of...
Was that humor in this market last week?
that was market humor.
The edge of SNL.
Let's move on. All I can say is
comedy.
you've seen some pretty the lowest correlation or the lowest breadth going back to 2001, and it raises this question of, does that portend some sort of decline, or is this just sort of a knee-jerk response to the idea that we haven't necessarily seen yields bottom out? I'm trying to keep going here.
Nice to see Chris Rock back, wasn't it?
It was.
Actually trying to make SNL funny again.
Yeah, he was good. I thought he was good.
Can we do that? Can we make SNL funny again?
I think that there could be segments, yeah.
Okay, cool. Just a few segments here and there.
All I can say is, I don't think I'm going to be the one doing it, as everyone just watched.
Let's turn to the bond market. It's where Bramo loves to be. 2-year, 10-year, 30-year. Yields are lower this morning by a basis point or 2 across the curve. Yields were materially higher through last week by more than 20 basis points on a 10-year and a 30-year. And lots of discussion, Lisa, over the weekend as to why.
And basically the idea here, and coalescing around this, and Steve Chivrone pointed to it, is that yes, this is a Federal Reserve that is going to cut by 25 basis points on Wednesday. That is consensus. The consensus is shifting to them being more hawkish when it comes to what they project for next year in terms of the revisions to the Statement of Economic Projection. And it seems like there is a coalescing around the idea that the neutral rate is going to be materially higher than what it has been in the past. And you can see that reflected in the yield curve and in the long end.
Reflected in the US dollar as well. The dollar index, DXY, has only had one down week through the whole of the fourth quarter so far. Another up week last week. Euro dollar right now looks like this. SocGen just reporting right now that Europe is stumbling towards 2025. I think we all agree with that sentiment. Euro dollar to break of 105, Lisa. 104.90. We're down 1/10%. Mark Wall over at Deutsche Bank reflected on the ECB meeting of last week. A group on the council is already proposing 50. The policy stance is still restrictive. Tariffs have not been factored into the ECB forecast yet. And the new language allows for the possibility of rates having to fall below neutral. So if you just remove Lagarde at the news conference and just take away everything else, it's setting up to be a pretty dovish ECB for 2025.
And that's typically the way you like to do it because, frankly, Christine Lagarde hasn't necessarily been on the front foot of signaling as far as what the ECB is going to do. Now the question is what the policies are actually going to be and what this means going forward at a time where you have the likes of Morgan Stanley saying they think this is a first half of the year story in terms of dollar strength. But once you start to get the implementation of some of these policies, you could see a reversal, especially if you do get disinflation that reasserts itself as a result of some certain particular tariffs.
Euro-dollar, 104.90. Under surveillance this morning, the data out of China, not great. The resale sales growth weakening in November, figures rising 3% from a year ago. The slowest pace in 3 months and undershooting even the most bearish of forecasts. The data highlighting the urgency for Beijing to once again encourage residents to spend. We've had a few head fakes on this front over the past few months.
And this is leading people to believe that the head fakes are from a number of other countries, namely in the United States, bringing forward demand for goods ahead of the potential implementation of tariffs. That is a sugar high, and it's not necessarily masking what's going on underneath, which is that consumers still aren't spending.
This comes also after policymakers said the second time in only a decade that they really want to boost consumption. But to be honest, there's been so many head fakes, it still feels like the Chinese consumer of the strict lockdowns of the pandemic. China has not been able to actually recover from the pandemic, and we are years out.
You know the big curveball from last week? I think it's the Reuters report on what they're going to do with foreign exchange. Got no idea how much weight you should put on that report from Reuters, but ultimately indicating that top leaders and policymakers are considering allowing the yuan to weaken in 2025 as they brace for higher U.S. trade tariffs. That a quote from Reuters just last week.
At a certain point, that suggests they're just going to lean into the one aspect of their economy that's been working, which is the export factory and cheap exports at a time when that is the one thing that keeps working. Key question is, how high will the walls be elsewhere? This brings a point up for Europe.
Watch this space. Speaking of Europe, Moody's cutting France's credit grade, citing concerns over the country's public finances and high deficit. This coming just hours after President Macron appointed Francois Bayrou as the country's prime minister. This, I have to say, is like, where have you been, Moody's?
Exactly.
Where have you been?
S&P and Fitch already had this rating level, so why is Moody's coming out after the political paralysis and the fact that this country cannot pass a budget? Deutsche Bank comes out and says their commentary, Moody's, on future deficits is quite damning, but the fact is it's a stable outlook for now and just brings it in line where S&P and Fitch are. So Moody's is a little bit late to the game, is fair to say.
All I can say is the fact that people were taking comfort that they weren't on watch for downgrade further tells you the state of play. I saw a number of relief messages, you know, okay, it's not that bad. It's just a downgrade, but at least they're not,
That's
you know.
the bar for Europe in 25, Grandma.
Exactly.
We're both on the same page. How little needs to go right for this market to move the other way?
That is the contrarian trade for 2025. Because at a certain point, you think about all the euphoria baked into the United States. You think about basically China left for this paralysis that we just saw. You see Europe left for dead. Maybe they don't have as bad of a budget deficit for a quarter, and all of a sudden people flood in. I mean, how much are we sort of setting up for that type of action?
That's France. Here's the latest on Germany. The Chancellor Olaf Scholz facing a parliamentary vote of confidence later on today. Scholz expected to lose, triggering a snap election on February 23rd. The new Chancellor facing a host of challenges, including a slowing economy and Russia's war on Ukraine. Bloomberg's Ollie Crook joins us now for more. Ollie, welcome to the programme. Fantastic reporting on the issues that Germany's facing over not just the last few weeks, but the last several years. Ollie, walk us through the next 24 hours before we get to the big issues further down the road.
Yeah, Jonathan, this all really began on November the 6th, really hours after Donald Trump was elected president of the United States, which, by the way, was very bad news for the political establishment here in Germany. Olaf Scholz firing his finance minister, basically disagreements over the budget, how to spend the money. And guess what? In an environment in Europe where you have basically zero growth, those budget negotiations become really, really tough, and they bring down governments, not just in Germany, but also in France. And here for Olaf Scholz today, that sort of governability question will be put on in full right behind me in the Bundestag at 1 p.m. He will go to the stage. He will deliver a 25-minute speech before lawmakers. A 2-hour debate between all the lawmakers will ensue after that. Then a sort of line vote, after which we get basically the outcome of the no confidence vote at 4 p.m. our time, at which point he can go to the president and basically dissolve the government, paving the way for that election on February 23rd. When we think about all of the issues that Germany is grappling with, we had PMI data out earlier today. Manufacturing still deep in contraction, 2.5 years of contraction. When you think about what these parties are presenting in terms of an economic platform for really changing things here in Germany, there is a sense to many people that I speak to that they're trying to treat cyclical disease with a sort of cyclical cure to a structural disease in Germany, all of the issues that you have underlying. And I think that that takes us really presently to the debate around the debt brake, which, by the way, Merkel just came out with her book. They brought the debt brake in 2009. They put it in the Constitution. That takes 2/3 majority to change. She says that that needs to be reformed. And what we're seeing from the platform from the CDU currently leading is that they will not move on the debt brake.
So just to be clear, even if there is new leadership, there are still a number of people and a majority that want to keep their commitment to not increase their deficit as they face off with a stagnant economy or a declining economy in the face of real structural change. Is that correct?
And I think that is the main question, is what is the point of having these really, really low borrowing costs if you don't use them when you need them? And yeah, that is basically the issue. But this is an issue we've seen across German politics historically. I mean, this is a country that shut down their nuclear energy capacity in the midst of an energy crisis. So you have a lot of these parties that have these very, very strict rules that are really unwilling to budge. And that has been part of the problem, is why this coalition did not succeed and fell apart just a couple of weeks ago.
Ollie, appreciate the update. No doubt we'll catch up tomorrow morning. Ollie Crook there out of Berlin this morning on the latest with the politics in Germany. Every road paved with failure seems to lead back to the German Chancellor, Angela Merkel.
She had a beautiful view of globalization and exporting to China and buying cheap goods from them and gas from Russia. Well, not exactly the panacea that we're looking at now, but why not increase the deficit? I just don't understand this. Maybe I'm just American.
Well, they have a debt break, and it's meaned years of underinvestment when it comes to infrastructure, when it comes to defense. You cannot talk about the current state of German politics and the German economy without talking about the legacies of Angela Merkel. And you mentioned Russian gas. That's one of the biggest ones. Basically, you had a Germany enslaved to this cheap gas that was able to boost their manufacturing space. They have yet to come over these policies, debt break, Russian gas, and it's just mean more political paralysis in Germany is going to continue.
It's an economy with huge structural problems. Let's talk about them right now with Sri, co-governor of Aberdeen. Sri, huge problems in Europe. Are they the kind of problems that the ECB can address?
I think the ECB has a very challenging outlook. You've already outlined a lot of the structural headwinds for Germany. And I think the political stasis that we're seeing is going to be something to monitor. But as you say, it's very difficult to generate growth in this environment. This morning, we already had the flash PMIs for both Germany and France, which were nudged higher, but they're still in contractionary territory. And we can see that divergence between manufacturing and service sector. And Germany being the engine of European growth and manufacturing being such a big component for driving German growth, I think the outlook there does look quite sluggish. So we are looking for relatively sluggish growth from the euro area going into 2025, 2026. And that is going to mean that the ECB will be dovish going forward. And we are expecting another four cuts from the ECB, and with rates settling around 2% by the second half of 2025. So they're going to be quite quick in terms of their easing path, very different to some of the other countries, particularly US, which has a very different growth backdrop. So as a way of growing out of a fiscal issue, that's something that is going to be challenging for euro area as a whole.
Sri, just to stay on Europe, do you think the fate of the European economy is in the hands of the European policymaker? That's the bigger question. Or are they at the mercy of what happens in China, what happens with US policy?
I think that's a very good point for next year. That's one of the big challenges, one of the risks that we have when we create our scenarios, our base case and our scenarios for investors. It is looking at the trade challenges going forward. Some of those trade barriers that are being discussed, just hinted at so far, nothing concrete just yet. We don't quite know what's happening in the US economy. And that's something that other central banks are looking at, including the ECB. We already had Christine Lagarde mentioning about a month ago, mentioning how we may need to shift our consumption patterns within Europe and maybe have to import other goods from the US. So there will be a degree of negotiation from policymakers, but that's very separate from the ECB. And what the ECB, the tools that they have, will be primarily through monetary policy and really through easing rates. And that will be, obviously they're going to say it's data dependent, but for now it does look like a fairly aggressive pace of easing. And that's something that they will have to do in order to help just shave off some of the bigger risks that the euro area are facing at the moment.
I want to just sort of build, though, on what John's getting at, which is if they cut, will they borrow? Right? I mean, basically, when you talk about a divergence between the U.S. and Europe, one of the key issues, we were talking about it with the German government, you can have really low rates, but governments and sometimes even companies won't borrow that much in order to invest and really innovate. If the ECB is accommodative, how much will that actually boost growth, boost the prospects for the region, and even give stability to the region's currency?
Yeah, I think in terms of the private sector, investment does need some certainty, and there are so many challenges. Domestically, you have political challenges. Globally, you have political challenges. Again, the uncertainty around the trade parameters are going to, unfortunately, be a headwind for investment from the business side over the course of next year. So we need to see some clarity, and we're not going to get that until the second half of the year, realistically. And in terms of government borrowing, obviously you've already discussed the debt brake is a challenge there, and it really depends on the makeup of the government after the February 23rd election. If you get to see some sort of coalition with the Greens, perhaps CDU and the Greens. However, that still, we have parties that are very much against changing the debt brake. So that is going to limit the amount of borrowing from the government there. So that's a challenge. And you're absolutely right. This is the time to really think about innovation and encouraging innovation from the corporate side in order to keep up with competitors in China. And the car industry is a prime example of that. The fact that the engine of German manufacturing is facing some big headwinds in the fact that that transition from ICE to EV has been, lackluster relative to China, which is miles ahead, and also other automakers across Asia. So I think that is a key challenge that needs to be addressed. Whether they'll address it next year, it's going to be very, very difficult to see that happening.
When it comes to addressing these challenges, do you see Europe acting in a bilateral stance with the United States, especially, or do you think Brussels will speak with one voice?
I think it will be with one voice. As it stands over the course of 2025, there is a risk to that. You're absolutely right in flagging it, where we have the far-right parties in France, in Germany, stating that they are going to be, they're even challenging the concept of the European Union. I think fragmentation risks are limited for now. It was very different. The situation of Brexit was very different in the form of the referendum and the way it was set at a very simple 50% level of winning or losing that argument. So I think that needs to be taken into account. Fragmentation risks are still marginal for now. But there is going to be some fairly loud voices in play. But I think ultimately what we saw in the 2016 Trump administration was tariffs being used to negotiate. We'll put on tariffs unless you shift your migration laws or you buy agricultural goods from us. There will be a period of negotiation there. And that's something that Europe is better to do as one voice. And there will be some challenges from these individual parties, but at the moment it seems that that one voice is still possible for the course of 2025. And next year is key in terms of setting the outlook for the next 5 years, actually, given these trade parameters moving.
Hey, Sri, thank you. It's good to hear from you, as always. Sri Koshyagovanan there of Aberdeen. What will it take, Lisa, to end Germany's love affair with fiscal austerity?
You're asking me? I think you need a therapist for that.
It's deep in the fabric of the German government. It's well documented. I remember when Wolfgang Schäuble, the former German finance minister, stepped down, and hundreds of employees of the ministry went outside dressed in black and made the shape of a zero for him. The black zero is deep in the fabric of that government.
And this goes straight back to the 1930s and what happened after World War II and after World War I. And it goes to this idea of we never want to see that kind of inflation ever again. And the scars of that go deep. At the same time, you think about all the people calling the American style evil in terms of spending more than you, borrowing more than you can spend. And, there's moderation here.
Euro dollar, 104.87, turning negative on the session. We're down about 0.1%. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. Starting with an update on the deadly shooting of United Health CEO Brian Thompson. Police claim to now have overwhelming evidence tying suspected gunman Luigi Maggione to the fatal shooting. He hired high-powered New York defense attorney Carrie Friedman Agnifilo to represent him. She could argue an insanity defense or challenge the evidence and may consider a guilty plea to reduce his potential prison term. Former House Speaker Nancy Pelosi is recovering from hip replacement surgery. Pelosi's office confirmed that the surgery took place at a U.S. military base in Germany. Pelosi, who is 84 years old, suffered from a fall on Friday in Luxembourg during an official trip and then was hospitalized. Her office did not describe the details of the severity of the injury, but added that she is well on the mend. And Tesla shares, those are moving higher just slightly by 1/3% after hitting a record high on Friday. Wedbush analyst, maybe to no one's surprise, Dan Ives raised his price target on the EV maker to a street high of $515 a share from $400. His bull case, though, is $650 or a $2.1 trillion valuation. Ives wrote in a note that the Trump White House will be a total game changer. And that's your brief. John.
Danny, thank you. We'll talk about Tesla later on the program, about 8:15 Eastern Time. Tom Narayan of RBC. Look out for that. Up next on the program, betting on a December rate cut.
January is probably going to be a pause. And that's really what's priced in the market. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
That seems to be the consensus right now. We'll talk about that next on the program. Live from New York, you're watching Bloomberg TV.
About artificial intelligence. Is artificial intelligence going to enable you and others to say we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Live from New York City, welcome to the program. The state of play, your scores look like this. Equity futures on the S&P up by 0.2%. A rally, a bid returns to the bond market. We're down 2 basis points on a 10-year, 437.30. Under surveillance this morning, betting on a December rate cut.
The number of rate cuts that they show in 2025 will go down from last time. All those things together will make it pretty clear that, January is probably going to be a pause. And that's really what's priced in the market. Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
So here's the latest this morning. Investors gearing up for a busy week of economic data. Global PMIs today, followed by retail sales on Tuesday. And a main event on Wednesday, a Fed decision and Chairman Powell news conference. Nita Richardson of ADP joins us now for more. Nita, good to see you. Good morning.
Good morning.
The word of the year for you. with regards to the labour market is stability.
That's
and I
right.
wonder how much stability we'll actually have in 2025 for this Federal Reserve.
Not much, in my view. I mean, the labor market is stable if you look at the main features of it. First of all, workers are staying put. Layoffs are very low by initial jobless claims. Hiring has been robust. The second thing we're looking at is pretty stable wages, but at an elevated level, and that's going to put pressure on the Fed as it seeks this 2% target. But even though wage growth has been at levels higher, people are working less. So for hourly workers, which make up 60% of the labor market, their pay is not keeping up with inflation. So there's this undercurrent of instability within the overall stable labor market. I don't think it stays stable in 2025.
So what hints are you getting of which direction it'll go in? Come on, just tell us where we're heading with this. Where is it going to break?
For the Fed or for the labor market?
Labor market.
I think what you're going to see is a little bit of hesitancy as you round the corner in January to admit new administration, potentially new policies. I think you're already seeing some hiring kind of back off when it comes to smaller firms. So we're watching that very closely. And if you tie a stable wage growth pattern with sticky inflation, what you're going to see is workers who are not as happy as they've been over the last few months. And we're already seeing that in our worker sentiment data, that kind of loyalty to their employer, that enthusiasm about work is starting to slip.
And how much is that the same on the other side? I mean, I think about the M&A boom that people are talking about. How much does M&A tend to lead to layoffs when there are certain efficiencies of scales?
That's a great question. We're expecting that activity, and we're going to be watching very closely about what the overall mark on the labor market will be. You would expect that there's going to be some churn, whether it's layoffs or people actually voluntarily quitting, as also happens during mergers and acquisitions. That might put some, churn in the labor market, which actually leads to higher wage growth, not lower. So something to watch, and again, it all circles back to inflation.
If more workers are staying at their current jobs, how hard is it right now to find a new job? Is it taking a lot longer?
It is taking a little longer, especially for college degree holders. And I think this is the shock and surprise of younger workers, new college grads in this year's market. They were used to what they heard from their friends who graduated 2 years ago, snapped up by the labor market. That's not happening. It's taking a little bit longer to get that job.
Is that because the employers just don't have the job? Or some of this, can we start saying, maybe is down to AI and more efficiency?
AI is going to affect where it's going to sink in is at those entry-level jobs, and that's true across industry. So excellent point there. We're not sure if that is actually happening right now because companies are still trying to implement their AI policies. What we're seeing is a slowdown after record high hiring in the last 2 years, and those college degrees just not getting, I tell young people when they contact me, and they often do, that networking is back in style.
Yeah.
Networking that may have been lost 2 years ago with this digital economy. You throw out your resume, somebody catches it. Now you might actually have to talk to someone face to face. And for Gen Z, that's a new skill to learn. Good one,
Top
though.
tip for the class of 2025, don't take advice from the class of 2021.
100%.
Don't take any advice whatsoever.
It's a different labor market.
Very different. A lot has changed. Nita, it's good to see you. Thank you. Nita Richardson of ADP. Up next on the program, Cassie Barrow of JP Morgan Asset Management, Henrietta Trace of Veda Partners, Will Van Loo of Quantum Capital Group, and Simeon Gutman of Morgan Stanley. With equity futures just about positive, this second hour of Bloomberg Surveillance is up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Go. I would say the Torsten Slock of Apollo is picking up the baton and writing the following. Recent inflation readings show signs that the decline in inflation has stalled. There is a risk of re-acceleration. He goes on to say, for investors, the big risk for next year, a repeat of 2022, where it was painful for both bonds and for stocks alike.
And we saw a hint of that last week. I mean, let's be clear. The sell-off that we saw in 10-year yields was not sort of an all-of-a-sudden momentary thing. It wasn't from failed auctions. The auctions were fine. This was a steady grind higher as people reassessed what the stickiness of inflation would be over long term and what the neutral rate would be. There is a real fear that we are underestimating the inflationary impacts of supply chain disruptions, but more importantly of immigration and the workers and the potential for salaries to really lead the increase. And that, I think, was really giving some people pause.
That's one part of the story. The second point supports that. It's the easing bias of the Federal Reserve at a time when you're seeing those things develop that I think is contributing to longer yields at the long end on both the 10 and the 30-year. When you hear people like Chris Waller, Fed governor, come out and say that they still believe they're a long way from neutral, that there's a lot of work to do just to get back to neutral, I think that speaks to an easing bias that still grips this Federal Reserve, regardless of what they signal for January.
And it raises a question of whether there truly is signal on the fact that the long end has risen in terms of yield so much since the Fed cut by 50 basis points. That still is a mystery. Is that simply analogous to what we've seen, or is there something more here that people are really looking at and saying, hold on, maybe they're going a little too soon?
Things are a little bit calmer this morning, at least. We're down 2 basis points on the 10-year. Let's call it 4.38. Coming up this hour, we'll catch up with Kelsey Barrow of JP Morgan as investors await Wednesday's Fed decision. Henrietta Trace of Veda Partners as Congress looks to avoid a pre-Christmas shutdown. And Will Van Lowe of Quantum Capital Group on the outlook for energy under a second Trump term. We begin this hour with stocks higher and bond yields just a little bit lower as markets await the last Fed decision of 2024. Kelsey Barrow of JP Morgan writing, "It is time to stop worrying about whether the Fed can continue cutting interest rates. Our New Year's resolution for investors is to embrace the current bond market, one where the zero lower bound and negative yields are becoming distant memories." Kelsey joins us now for more. Kelsey, good morning.
Good morning.
Can we start with the moves of last week? What do you think underpinned that move at the long end, on a 10-year, on a 30-year?
Yeah, so it is interesting. The move last week, I don't really think was connected to anything specific as it relates to the auctions. Lisa, as you mentioned, the auctions were fine. I actually think the data is generally still consistent with the Fed's current easing bias. So my interpretation of the inflation data, I actually think that they're going to see that and think on the margin it's actually positive. Because when you look at the read-through of inflation to core PCE, softer in November, and I think the key thing they were looking at in terms of the inflation data last week that was really monumental, that people aren't really looking at, I don't think as much as they should, is the step down we've seen in shelter inflation. So that shelter inflation, that renormalization of OER and primary rent back to pre-COVID levels, that's not fed through to the year-over-year rates. So if that continues, and I'm not saying shelter inflation is going to slow further from here, just maintain its pre-COVID trend, you have disinflation in the pipeline on a year-over-year basis that's going to bring core PCE closer to 2.25 by March. So again, there's different ways to interpret the inflation data, but I actually think the inflation data has been telling the Fed we stalled on progress for a little bit, but things are generally going in the right direction. So that brings us back to why were yields higher last week. I think people are setting up for the potential for the Fed to sound hawkish, and I think that that's probably already in the price. And now we may be looking at more of a potential, if the Fed were to surprise either way, it could actually be to the dovish side because the market's only pricing 2 cuts next year. And for the Fed's perspective, I don't think that they've seen a lot has changed yet because they can't, and the market's forward looking. The Fed, on the other hand, you know, they're still stuck in the information that they know.
The consensus view is to cut this week and to skip January. Do you challenge that?
So I think it's a fair base case. It's in line with our base case. But when I look at the probability of January being lower than 25%, that I think, you know, that could still shift between now and the next decision, depending on the data we get, particularly on the labor market. So the labor market data has been incredibly choppy, but as your last guest mentioned, beneath the surface, it's taking longer for people to find jobs. The unemployment rate is actually creeping back higher to where it was over the summer. That's the reason that the Fed is really, you know, focused on maintaining this easing bias, despite the fact that inflation has taken longer to get back to target.
I guess a real tell will be if the Fed does act in a more dovish way and signal something that is more dovish than the market was expecting. Do you expect the long end of the yield curve to rally or sell off?
I think it's probably stable around here. So I wouldn't expect a big move in either way, but I would say in terms of our risk budget, where are we putting risk to work in our portfolios? We've actually been staying pretty neutral as it relates to US duration. Where are we putting risk to work? One, on the curve. So I still think there is scope for the curve, the US curve, to steepen. Maybe it would be a bit of a twist steepen where you have the front end fall and the long end rise. And then also, if you're not buying duration in the US, you know, we're still fixed income investors. What we do is we buy duration and we're buying it in other places. The UK, Europe, and more recently Australia. Australia is one of the last central banks that hasn't started their easing cycle yet. So there's plenty of other places, you know, to look at.
You make a legitimate case for the U.S., but it's complicated. When you start talking about the yield curve and exactly how things are going to respond, it's not the clean case of an ECB that's talking about the potential for not necessarily not just not restrictive, but even easier monetary policy. When you have a Swiss National Bank policy president talking about negative rates, no one likes them, but, you know, they work. So at what point do you just sort of forget about the U.S. and go Europe, go Australia?
Right. I mean, and that's essentially what we're doing. So, you know, you can stay fairly close to home as it relates to the U.S. right now and wait for larger dislocations and take that risk budget and put it other places. The other place that we continue to lean into is credit. Credit has performed very, very well this year. And so, you know, one of the things that we've been focused on, there's a lot of airtime, and I contribute to that airtime on the Fed. And the fact that, you know, the Fed has cut, but not nearly as much as what people were anticipating at the start of the year. That's actually been a good thing, you know, because it reflects the fact that economic growth has been extremely strong. And if you were to invest it in high yield at the start of 2024, you're looking at high single-digit returns. You got the carry, you got a little bit of spread compression, and that's still an area where we see a lot of opportunity.
Triple C spreads pushing 9 in the summer, now have a 5 handle. What's going on with the riskiest part of credit?
So in the riskiest part of credit, there's a lot of more idiosyncratic stories within the telecom sector, for example. And those are places that, you know, you really need to understand the specific company fundamentals, company situations that are going on. But I would say more broadly about the high yield universe is that it is so much cleaner of a universe than it's really ever been. And the way that, you know, I think is really striking to look at it is to look at the divergence between defaults in high yield versus defaults in leveraged loans. Those have diverged. Now, both are still low. But really, the high yield universe is extremely clean, and that's why, you know, when I look at spreads that are so tight, is it justified by the fundamentals? I would say it is.
Rational or irrational exuberance gripping the credit market, Bramo? Which one is it?
You know, a key structural question is whether the private credit market puts a floor under the quality of the public credit markets, including Triple C. And it's the reason why people are talking about a very different quality of the entire high yield public market that is different than the previous one. How much is that what's at play here?
I mean, I think that is definitely a significant story. So if you just think about the growth in private credit, it's gone from something that was, you know, very small relative to the high yield and syndicated loan market to one that rivals the size of the two of them. So it is a legitimate and full asset class. And so the trends have changed. And so just to compare, you know, the index spread on high yield today versus the history is missing the point because the index itself has changed in terms of the quality.
And John, there's been this whole restructuring where basically you took all of the private debt and you put it in the public hands. And basically you've seen leverage balloon in the public market, U.S. government, sure. And everyone else looks a lot better. And essentially there's this question of, can you really have your lunch and eat it too? And everyone's thinking, yeah, I think so. We're going to buy some credit.
You cited quality, but I cited triple Cs directly. Are we saying that triple Cs aren't what triple Cs used to be?
Well, in triple Cs is, again, it's very idiosyncratic and company specific. So we're actually quite involved in that space. But you have to have the resources, the research desk, the people who understand the law aspect of it, the litigation aspect of it. And so, that is a really specific pick your spots type of situation. So the way that we've been doing it is kind of a little bit of a barbell. So you choose your spots in triple C's where, we're involved and we're active in the negotiations of restructuring. And then on the other hand, you have the companies that we feel really comfortable about more on the higher quality side of the high yield market.
Credit spreads are super, super tight. Kelsey, it's good to see you. As always, Kelsey Barrow there of JP Morgan. Equity futures are positive by about 0.2% with an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. South Korea's parliament has voted to impeach President Yoon on Saturday, following his brief martial law declaration earlier this month. With his duties now suspended, Yoon awaits a ruling from the country's constitutional court on whether he will be removed or restored to office. That decision can take up to 180 days from the passage of the impeachment. Bloomberg has learned that Apple is developing a giant foldable iPad-like device. The company is aiming for a 2028 release of the product. It would unfold into the size of 2 iPad Pros. Apple's goal is to avoid the crease that current products have when the screen is opened. Apple is also exploring a foldable iPhone. And the Kansas City Chiefs trounced the Cleveland Browns 21-7 with Patrick Mahomes throwing 2 touchdown passes before leaving the game with an injured ankle. The Philadelphia Eagles beat the Steelers 27-13 for a franchise-best 10th straight win. The New York Giants, though, suffered a franchise record-tying 9th straight loss to the Baltimore Ravens. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, a spending fight on Capitol Hill.
Where anybody's going to be willing to cut is, anybody's guess, and the deficit just keeps getting bigger, and the overall national debt keeps getting bigger. Sooner or later, that debt will catch up with us.
You see Janet Yellen in the last week or so regretful they didn't do anything about it.
Very regretful, although she was in a position to talk about it in a different way for years, but waited until the way out to say someone else's problem now.
It's like catching people at 3 a.m. stumbling out of a nightclub. Regretful that they drank too much. What does that even mean?
The walk of shame. It's the walk of debt shame.
My goodness, that's nice. I like that.
Thank you.
From New York City this morning, good morning.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Just a snapshot of financial markets stateside, both in equities and bonds at the moment. Equities okay, up 0.25%. Bonds rallying 2, down about 3 basis points on the 10-year, 436.91. Under surveillance this morning, a spending fight on Capitol Hill.
Offsetting costs seem to be, something Congress doesn't seem to feel like they have to do anymore. I mean, it's been a long time since sort of the grand bargain. And even though bargain technically fell apart, Republicans still got $80 billion worth of cuts in the budget. Where anybody's going to be willing to cut is, anybody's guess. And the deficit just keeps getting bigger, and the overall national debt keeps getting bigger. Sooner or later, that debt will catch up with us.
So here's the latest this morning. Lawmakers struggling to avert a government shutdown before Friday's midnight deadline. The measure expected to set a new March funding deadline, pushing the issue to Trump's second term. Henrietta Trays of Vader Partners writing, investors should read into this bill that contrary to the assertions of the incoming Trump administration, federal spending will not be cut next year. Henrietta joins us now for more. Henrietta, welcome to the program, as always. Can we put a number on this for 2025? Just how big will that deficit actually be?
Well, sure. I'll put it into some context for you. The NDAA is going to increase federal spending by 1% over $884 billion. That's just one bill. And then the CR that they'll pass by the end of this week is going to increase federal spending by at least $100 billion as they try to just compensate for the hurricanes and typhoons and other disaster relief. So that's just to get us through March. We'll continue that spending pace for the rest of the year.
I thought we weren't supposed to be in this process the week before Christmas. Speaker Johnson said he wanted to make sure everything was over and there wasn't, this Christmas tree wish list of jamming whatever you can into a CR. What happened?
Emery, it's a perfect example of what we're going to get into next year. When you have a 0-seat margin in the House, you have to delay release of this politically sort of painful or toxic legislation that does the opposite of what you intended to do. So you get these last-minute pieces of legislation, hope that members will vote for it on, jet fumes as they're trying to get out of D.C. And that is a huge component of just getting this bill turned into law, is wait until the last minute. And I expect that we'll see that not just once, but twice next year, as Republicans have to negotiate with Democrats on a government funding bill into March 15th and beyond, and then also on the debt ceiling, which could either be in March or more realistically, probably in July, when we start hitting up against that deadline.
Is there any chance they put provisions in this upcoming CR about the debt ceiling, given the fact that this is game on January 1st?
Not this CR. I don't expect to see the debt ceiling attached to this CR. They can't do the debt ceiling politically until they absolutely have to, and I don't think negotiations with Democrats are going to bear fruit on that front. My big question is whether it's going to be addressed in the March 2025 CR or if they're going to keep it as a whole different package. Late last week, Senator Lindsey Graham, who's going to be the Budget Committee chairman, indicated that he will not be including the debt ceiling in a reconciliation bill, which means that Republicans are going to have to negotiate with Democrats. It's a politically toxic piece of legislation that will either suspend the debt ceiling for another year or two, and alternatively increase the debt ceiling by another $1.5 trillion just to get you a year of functionality.
These bills that we're talking about is just for the government to function. When are we going to see the lawmakers talk about some of the policies, given the fact that they had this sweep, in a reconciliation bill?
Yeah, that's happening right now behind the scenes, and they're trying to figure out if they're going to go with two pieces of legislation or just one. The Senate would like two bills, knowing and acknowledging that the tax bill is going to take all year to write. If you wait for just one piece of legislation that includes a massive $4.6 trillion deficit increasing tax bill, then you're probably going to need to effectively give Trump no legislative wins until December 2025. That's obviously politically missing an opportunity. And I think what incoming leader Thune is recognizing is that they could get a small reconciliation bill in the first half of the year that addresses the border, military spending, and immigration components, and that's going to spend anywhere between $20 and $200 billion. So that bill they would try to pass first. They're working behind the scenes now to pull that reconciliation package together. But to put this into some context, the House Republican Conference isn't even going to meet on this topic until January 4th. So it's going to be a while. It's going to take all of first quarter 2025 to write that if they get it done.
Henrietta, our bar is so low that we are hopeful that the members of Congress can get together and just keep the government open for another couple of months before they can reconsider whether or not to keep the government open. We were talking with Terry Haynes about a real fundamental question about a vacuum of power in Washington, D.C. as a host of threats face off, whether it's drones, whether it's spying from China, whether it's some really unfortunate incidents that happened on an Army base over the weekend. What do you make of just how vast this vacuum of power is right now?
I mean, that really is stuff that the House and Senate are not equipped to handle quickly. They cannot pass legislation with any kind of speed. And as you pointing out with the CR, they usually only do things under duress at the last minute. So that's really an arena for either a state government or the president to do whatever he's able to do under executive order. But it's just not what the House and Senate are equipped for.
One of the aspects of government that tends to bring comfort or fear, depending on your beliefs, is that there are a core group of people who don't focus on sort of the winds of politics, that are just keeping their nose to the grindstone and paying attention to what the threats are, to surveilling the skies. Are those people staying and doing those jobs? Are they leaving? Do we have a sense of whether that infrastructure is intact?
You know, those core competencies, those civil servants that are in the federal government are folks that have chosen to dedicate their life to this. And what I think is really notable and missed in the conversation around DOGE and cutting the employee workforce is that for the last 40 years, federal employee rates have been effectively flat, meaning this is not a situation where you have some growing corporation that has this boost of employee activity. This is a relatively stable 40-year norm for a federal government that has gotten much bigger in terms of its daily interactions, its legislation, responding to a pandemic, the Great Recession, the Affordable Care Act, the Chips and Sciences Act. You pass all these massive bills that should grow major departments like the Department of Commerce, for example, under Secretary Raimondo. When you're investing in infrastructure with $1.5 trillion, when you're investing in chips and sciences and doling out these massive grants across the country to grow batteries and semiconductor chips and all those plants for the emerging economy, you expect it to get bigger, but that's not the kind of bloat we see in the federal government. And those folks hopefully will stick around.
Henrietta, Lisa was using language that only comes to mind when you talk about drones, talking about surveillancing what's going on. Do you think in this new CR that we have coming up, there could be new regulatory rules regarding drones, given the fact that we've seen bipartisan criticism about what's going on right now in neighboring New Jersey?
I would be really surprised. Right now, they're really tied up over the Farm Bill and another aid package as we anticipate that Trump launches additional tariffs that China then responds to and hits farmers. As you know, there were 3 farmers bailouts in the first Trump term, and they're trying to sort of get ahead of the tariffs that are coming by providing them with a preemptory this bailout package in this CR. So that's what the debate is about right now. I haven't seen it get sideways about drones, but obviously Senator Schumer, the current majority leader, is interested in the topic. So it's possible, but you mentioned that Christmas tree at the beginning. They're going to try to keep controversial stuff out of this to the extent possible, and they're already tripping over just over Farm Aid.
Are they lying to us about the drones? Henrietta, yes or no?
That's above my pay grade. I don't know.
Henrietta Trace there, Fader Partners. We'll let you go. It's good to see you. Thank you. We've talked about this a few times already this morning. Option 1, they either know and they're not telling us, or option 2, they don't know and that's terrifying. Which one is it?
And which one do we prefer? Honestly, I hope it's that we're being gaslit. That's at this point, I hope that that's the case. But that does seem to be the reason why people are concerned.
Well, you don't really see on the weekend a number of officials from Homeland Security, FBI, come out and have to talk to reporters because of the uproar that we are seeing with these drones. The fact that a local airport had to be shut down. And then Mayorkas comes out and he says one reason for the increase in sightings that in September 2023, the FAA allowed nighttime drone flights. Well, why did the FAA allow that? Why?
There's a reason for the loss of trust, and you mentioned it earlier on this morning. The spy balloon of almost 2 years ago. Now, wasn't a thing. Oh, it's a thing. We got to shoot it down.
Yeah, there have been a series of these. Maybe they're just Christmas drones, you know, Christmas lights.
Christmas drones.
Yeah.
Of course. What did the Chinese say that weather balloon was? A weather balloon.
A weather balloon.
Yes, of course. Not
there
a spy
you go.
balloon at all.
A climate balloon. Of course.
There we go. Up next on the programme, Will Van Loo of Quantum Capital Group on surging investment to power AI.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
I get the temptation to be bearish right now. I'm just glancing at Bramo as I say that. But it's been expensive to be bearish through this year. Equities at all-time highs, credit spreads are really tight, Bitcoin's on a 7-week run, make it 8 weeks after this morning's advance.
Some people bought when mortgage rates were low. That's all I could say.
It's true. That was the call of the century. Barron's. I bring this up because Barron's went with embrace the bubble.
Yeah.
You see that over the weekend?
Well, yeah, I mean, this is basically what we hear from everybody. I mean, Brian Levitt was on, and he said, you know, I was the FOMO kind of guy. I was like, are you still FOMO? He's like, you know, like you can't be. So everyone's in this Goldilocks time. Look, have I been so bearish? Have I been raising the prospect of Armageddon?
On a relative basis?
Sure.
Less so since the election. I'd say you're less bearish.
I mean, look, I think that there is a narrative that can be painted that things are going to look really ugly tomorrow, but it's the holiday season.
You're doing it just because Christmas is around the corner.
100%.
How generous of you. Equity futures right now, the S&P 500 advancing by 0.25%. On the NASDAQ 100, we're higher by almost 0.5% now, following a 4-week run for big cap tech in America. With your morning movers, let's cross over to Manus Cranny. Good morning, Manus.
Jonathan, good morning. Welcome back. Good to see you. The personification of activism is displayed in this stock this morning. Honeywell. Elliott took a $5 billion position in them early in the autumn. They wanted radical change, and bam, bam, bam. Here we go. Unlocking shareholder value. Read shake-up. Aerospace division. Potential separation. Transformational changes. It basically means somebody's got a $5 billion stake. They want change. They want their payback, and that is what Elliott are extracting today. We need to understand the valuation around this aerospace business. Of course, this company took a $400 million downgrade on their sales, the free cash flow down by $500 million. So maybe activism has merit and value in this particular stock. Ford gets a downgrade from Jefferies. Interesting stuff. They're talking about $9 on the share. You've now got the most amount of sell ratings on Ford since 2009. Nearly went for 1999. The sell equivalent rating. One of the big decisions they're going to have to make, according to Jefferies, is this, Jonathan, resizing, if not exiting from Europe. So there's a lot of issues around that call. I take you to Capri. Take your mind back a couple of months ago, bailed on this deal. It fell apart with Tapestry. It looks like they've appointed, well, we understand that they're talking to bankers about finding buyers for the two brands in the stable, Versace and Jimmy Choo. The question is, do they go as a one-stop shop, or is it separation and creating perhaps a little bit more value there? Jonathan.
Manus Cranny, thank you. Protect that affordable luxury. It's the objective of the US government.
That's all it was with the antitrust. Yeah. It was not just luxury, it was affordable luxury. I didn't even realize that was
affordable luxury. Is that luxury by definition? I'm not sure it is. Under surveillance this morning, Secretary of State Antony Blinken saying the US held direct talks with the Syrian rebel government. Blinken also holding out the prospect of sanctions relief as Syria's post-asset transition meets goals laid out by the United States.
This is going to be challenging because HTS is deemed a terrorist organization by the U.S. government, a number of people. So how do you lift sanctions on HTS? At the same time, they're coming in with a little bit of a change of tune on how they would like to govern. And if they are going to govern and Assad is not there and there is this power vacuum, they would need sanctions relief for the idea of being able to make sure that fuel and food are able to get into the country. Very challenging time. Luckily for this administration, though, they'll be handing off this problem to someone else.
Just to jump in, what is it about Syria and sanctions relief with this administration? Wasn't there a report suggesting that they were willing, or at least exploring, removing sanctions on Assad before this even happened?
So I have some reporting on this, but came weeks after, and shout out to Reuters, who got this early in December, that they were saying that the Biden administration and the UAE were in talks and discussion of potentially lifting sanctions on Assad. And the reason for this would be to try to push Iran back, to isolate Iran. If you lift some sanctions on Assad, maybe you bring him more into the fray of the Arab world in the Middle East and push back on Iran. What spells out for me, though, the second I read this report and then you saw the fall of Assad, was this administration, if they were considering even discussions of lifting sanctions on Assad, meant they had no clue that that government was so weak that he was about to fall.
They've missed a lot of things in the Middle East over the last few years, that's for sure. Let's turn to our next story. Homeland Security Secretary Alejandro Mayorkas saying that drone sightings, mostly concentrated in New Jersey, don't pose any public or national security threat. Mayorkas saying increased sightings could be the result of 2023 FAA rules allowing nighttime drone flights.
Why did they allow nighttime drone flights? I mean, that's another question. This, though, coming from a number of different sources. Okay, we had two scenarios. One, they don't know, and that's scary. Two, they're gaslighting us. They do know, and there's something else. Third, what if those drones are looking for something, say like radioactive material or something specific that could be a threat? You know, I mean, there was the prospect of aliens, but I don't believe that. I think that there is this question about, is there something else? And I think that that really goes to this crux of a vacuum of power right now, a vacuum of leadership that raises some concerns for a lot of people.
If you have no policy in Congress when it comes to things like drones, everyday people can buy them, go out, you and I can go out and maybe buy a drone. If it's less than half a pound, we don't even have to register it. Or it can go into the hands of adversaries. And that is the concern that is happening right now, especially when they're over critical infrastructure or you know, near where airplanes are taking off and landing.
I was once in Florida, and there was this group of guys that had this beautiful new drone. And they came over, and they set it up, and everyone gathered around to watch it. And they made it go, and it promptly got stuck in a tree. They spent the rest of the afternoon trying to get it out. So
that's your experience of drones?
That's my experience with drones.
Gaslighting. I think we need to talk about how much the general public in this country has been gaslit by this administration over the last several years. You talked about the article, I think, in the Journal earlier on this morning, on the border, on the president's mental acuity, on issue after issue. This general public, I think, feels like they've been gaslit by the Biden administration on several issues over the last several years.
And when it comes to the drone, the issue that many feel the most gaslit by, similar to this, has to be the Chinese spy balloon. They were told it's not a big deal, and then it was told, actually, we are concerned, and we're going to not actually have our top diplomat go to Beijing because of it. This is how the editorial board at the Wall Street Journal puts it. The Biden administration has squandered its credibility to point that it's rational not to believe what it says. And that is why people, including Democratic lawmakers and governors, are saying, actually, we want more information on these drones.
Another 1 month left. Let's turn to Apple, reportedly working on a foldable iPad for a release in 2028. Sources telling Bloomberg's Mark Gurman. Designers are developing something like a giant iPad that unfolds into the size of 2 iPad Pros side by side. Apple also exploring, reportedly, the idea of a foldable iPhone as well. So they're finally making a move.
Well, yeah, but here's the obstacle. Get rid of the crease. They can't get rid of the crease.
No.
But this is the whole thing, is that they might get rid of the crease. And this is sort of Apple's playbook, is do it late, but do it better. And so if they can get rid of the crease, that's sort of the holy grail.
So the prototype of this device, quotes, have a nearly invisible crease. If you don't have the crease, then yeah, why not? Maybe this is something worth buying. I don't know why everything needs to be foldable, though.
So we're waiting for the foldable phone before upgrading now.
Oh, God. Really?
So the cycle is further down the road.
Okay, this is for you, for the Pharaoh
Well, actually, I think it's for people who do not carry handbags. I know Jonathan doesn't, because if you don't have a handbag...
Thanks for clarifying.
You should get some affordable ones.
You need a phone if you want a bigger screen, but it has to be able to fit into your pocket.
I was in the market for a Coach handbag, and I'm pleased that the president's protected them. That was very important to me. going into 2025. Let's talk about the rise of AI fueling energy demand. Goldman Sachs estimating US data centers will use 8% of total power in a country by 2030, or 3 times the level from 2022. Will Van Loo is the CEO of Quantum Capital Group, one of the largest private capital providers to the global energy industry. And Will joins us now. Will, good morning.
Good morning.
It's good to see you, sir. The incoming president wants to unlock energy in America. Drill, baby, drill is something we heard from him repeatedly on the campaign trail. How difficult is that actually going to be?
Well, first of all, thank you for having me on this morning. It's going to be very difficult. And in terms of oil and gas production, oil in particular, we have really developed most of the shale resource plays. And other than the Permian, they're all either peaking and rolling into decline, or they will soon. And I think the Permian, maybe we can get another 1 million or 2 million barrels a day out of it. So we produce about 13.5 million barrels a day right now. So maybe it gets up to 14.5 or 15.5. But that would really be the physical limitations of the Permian.
Given the fact that there seems to be a long runway for anything in terms of infrastructure in the energy space, what could changes in the Trump policies next year actually do fundamentally to shift the investing landscape, to shift sort of the energy landscape from your perspective?
Right. Well, I think the biggest thing is lifting this LNG pause that got put on last year. You know, there were tens of billions of dollars of investment that were slated to go into the next phase of LNG build out. That's critical for our allies. That's critical for America projecting its power throughout the world to be able to export that energy. So I think that's the biggest thing that he could do immediately. And he said, you know, first day in office, that's something very likely may do. But I think other than that, permitting reform is the biggest thing that we really need. And that's not only for oil and gas, but that's also for transmission. I mean, that's the big is the wind and solar build out continues. The biggest bottleneck is transmission. So I think having regulatory kind of relief in terms of how long it takes to get these power lines permitted, permitting midstream pipelines so we can get that gas. America has a lot of natural gas. We have a lot more natural gas than we do oil. And so we've got to be able to build the critical infrastructure to get that power and that gas around the country.
What's been fascinating to so many people is that there is a dissonance right now to all the discussions around artificial intelligence, the energy that's required to power that, and then just how long the process is to build it out from an infrastructure process, and then the fact that policies tend to ping pong and they change quite considerably. How do you get around that when you're investing to try to cater to what seems like a really big opportunity but has these major pitfalls?
Yeah, I mean, look, it's AI, a typical AI query, generative AI query, takes 10 times the amount of power that a regular Google search takes, right? And so when you look at, you mentioned that power demand will literally triple for data centers over the next kind of 5 to 6 years. That's a massive amount of power. You know, a data center, say a 1 gigawatt gas turbine that fires a data center could power 800,000 homes. So you think about that. A data center demand for power is going to grow about 50 gigawatts over the next 6 years. That's enough power. We're going to have to install enough power to power 40 million homes. That's a lot of power.
Wow, absolutely. When John started off the conversation, they're talking about drill, baby, drill. I can't help but think that President Trump was elected, and then a few weeks later, Chevron is saying, actually, we're going to pull back on the Permian. Do you see more U.S. oil producers pulling back on drilling? Because actually, the oil right now, price point is just not advantageous.
That's correct. So you look at where prices are today, the inventory that's left that's economic at these levels, and that's why I say that you got to be very careful about projecting how much production U.S. can actually grow. And so at these prices, no, I don't see anybody drilling more.
Do you think then the Trump administration would be more willing to either accept what the Biden administration might do on their way out or do it themselves, which is to maybe start to hold back on Russian oil, saying instead of this price cap, we're actually going to sanction oil outright, really hurt Putin. At the same time, if the prices go up, that actually might be better for U.S. drillers.
Yeah, I mean, it's difficult. I mean, there has been sanctions in place, arguably not very good ones. And so I do think that's clearly, it's been rumored to be talked about. How effective it'll be, I don't know. But I will say I do think that President Trump is very focused on keeping energy prices low for the American consumer, and sanctioning Russian oil would have just the opposite effect of that.
The other thing you mentioned, of course, is gas and how the U.S. has so much natural gas, and you think we're going to see executive orders when it comes to these LNG permits. Do you see deals growing, say, for the United States and Europe, because they're looking for some sort of bipartisan wedge into acquiescing themselves to the Trump administration?
Well, Europe is still buying a lot of gas from Russia. It's not talked about very much, but they have to, okay? And so that's absolutely why we need American LNG to be expanded significantly. We have the gas to supply to our allies in Europe. And so, you know, I think that's going to be a very critical part of Trump's energy policy, and it's something that really needs to happen.
In the meantime, given that all these policies are sort of question marks right now, how much are you going to the sure thing, which is tech companies themselves, and working directly with them in order to build out energy? Because they need it, and they need some certainty, and you could probably provide that with the pool of capital that you have.
Yeah, so I think a couple things are going to happen. The problem with all the growth in AI demand for electricity is it still takes 4 to 5 years to go get a new gas-fired power plant built. And so we have to look at the existing asset base in the U.S. today. If you look at the roughly 200 gas turbines that are installed generating power that are greater than 500 megawatts, those run at about a 55–56% capacity factor, okay? So there's a lot of capacity left in existing assets. It's just, are the regulators going to allow the tech companies to take that excess power? Because that excess power is needed whenever it gets really cold or it gets really hot and demand surges. And that's going to be the real kind of tug and pull is we have it. It's going to take a lot longer to build out the new power plants, but how is that going to play out between the consumer on one hand and the tech companies on the other hand?
In 5 to 10 years, how different is the backdrop going to look for big energy in the United States at a time where big oil has been sort of self-constrained in a number of different ways from their investing programs, and you have upstarts like not only yourself, but a whole host of private investors who are trying to really get in alongside big tech?
Yeah. So I think there's a lot of capital that's been formed. You've heard about these huge partnerships over the last couple of months that are all kind of around data centers and supplying that power for data centers. If you think about it, if you spend $1 billion on power for a data center, you're going to spend about $10 billion on the data center itself, another $20 billion on chips. So the power component's only about a little over 3% of the total cost of a data center. So I think there's going to be clearly the big tech companies are going to have to partner with both private and public companies to get that power. But the truth is most of the power is controlled by big utilities, regulated utilities. And so I do think you'll see a lot more private companies coming into that space to partner with the big tech companies.
Americans do not want European energy prices, that's for sure. I'm wondering how much pressure there will be on providers to make coal great again. How pragmatic do you think politicians, leaders in America are going to be on that issue?
Well, you know, if you look at the United States, we have retired a lot of our coal plants over the last couple of decades. Europe's retired even more. Just a few months ago, the UK retired their last remaining coal plant, which is an extraordinary statistic. They've had it over 150 years.
It's amazing. And I see the government leaders celebrate it all the time. And then my mum calls me and tells me what her electricity bill was.
That's right.
What her fuel bill was. And it's astronomical.
And what you got to appreciate is in every other part of the world, China uses more coal than they've ever. We use more coal today in the world than we've ever used before, despite all the drumbeat about how we've massively reduced the reliance on it. We have in the West. The rest of the world, India, China, you know, it's exploding. And so that's it. It's not really matter. It doesn't matter where it's burned. There's one atmosphere, right? And that's the other thing we have to appreciate. So coal use is going to continue to go up. I don't think it will necessarily in the U.S. It will in Europe whenever they get really cold or really hot, and that's the only fuel they have. But in Asia in particular, you're going to continue to see massive use of coal. Why? Because that's the fuel that they actually have. It's about energy security. And that China uses EVs, not because they love the environment, but because they can burn coal to power those EVs and not have to import gasoline.
Amazing. Well, it's good to see you. Thank
Always
you,
good
sir.
to see you all.
Will Van Loo of Quantum Capital Group. Amazing, of course, for all the wrong reasons. With an update on stories elsewhere this morning, here's your Bloomberg Brief. It's Danny Berger. Hey, Danny.
Hey, John. SoftBank CEO Masayoshi Son is expected to announce this morning that he'll invest $100 billion in the U.S. over 4 years. A person familiar says that Son will make the announcement at a press conference with President-elect Trump. It will also include a promise of creating 100,000 jobs focused on AI and related infrastructure. The pending Skydance-Paramount merger is facing more critics. In an FCC filing, Fuse Media said that the combined entity would have more power to prioritize its own content over independent programmers like Fuse. Echoing concerns raised by manager Mario Gabelli, Fuse also argued that Sherry Redstone would be overpaid in the deal. Disney's Moana 2 topped the North American box office for a third consecutive week. According to ComScore, the sequel grossed $337.5 million in North America. In second place, Universal Pictures' Wicked earned $22.5 million on its fourth weekend. Rounding out the top three, Sony's superhero film Kraven the Hunter debuted to a $11 million opening. And that is your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the looming tariff threat.
The big question and the big opportunity and the big unintended consequence of tariffs will be passing this cost on to consumers, which may yield inflation. So we'll see.
That conversation up next.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but you can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never.
We'll do it for fun.
Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Equity futures right now in the S&P positive by 0.25%. Under surveillance this morning, the looming tariff threat.
The big question and the big opportunity and the big unintended consequence of tariffs will be passing this cost on to consumers, which may yield inflation. So we'll see. We think as much as 50 to 90% will need to be passed on to consumers, and it's something to watch.
So here's the latest this morning. Retailers and consumers bracing for President-elect Donald Trump's proposed tariffs. Simeon Gutman of Morgan Stanley writing, US-centric companies are better positioned near-term sentiment-wise, given recent dollar strength and tariff risks for multinationals. Simeon joins us now for more. Simeon, it's good to see you. The note that you've put out, a private label tipping point. Why do you think private label is going to win when we embrace and brace for what could come down the road in 2025?
Thanks for having me on a Monday to talk private label. Think about what's happened in the last few years. We've had rampant inflation. Consumers are paying 30% more for food. All the retailers, food retailers, discount retailers, are introducing new products, private label products. Private label used to be synonymous with lower price. Now it's becoming higher quality. They're fighting back the price increases to give value to their consumers, and they're innovating like never before. The quality has taken a quantum leap, and that's what we're seeing starting to shift.
Who's winning this?
There's a few very large winners. Costco in Kirkland, they've already been a winner. That's one of the largest brands in the world, and they go across multiple categories. If you think about some of the individual retailers, Trader Joe's and Aldi, those are private label houses. They've taught the customer that this product is good quality, it's reliable, it's trustworthy. On the come, it's still Walmart, introducing new products, Target, and some of the large grocers like Kroger and Albertsons.
Are they commandeering the supply chains with their private labels?
They're working to. I mean, we've seen a few rifts in the private label world. Look at what Costco did with their rotisserie chicken. They couldn't get enough supply, so if you can't buy them from someone, you build a plant and you run it. And this way you can keep the price, the famous $5.99 rotisserie chicken.
The fact that you think there's going to be a super cycle, the latest boost to that, is that because of multinationals are really going to suffer under potentially a Trump administration with tariffs?
A little bit. I mean, we could go on that angle. Now, a lot of food, shelf-stable food, is still made in this country, and a lot of refrigerated and frozen food made in this country. But it's all about price increases and finding ways to deliver more value to the consumer. But we're seeing this shift where these mega platforms, Walmarts and Amazons and Costco's, they're garnering a much bigger percentage of overall consumer spend.
Are we misunderstanding the story when we say that people are down trading to Walmart? That maybe it's that Walmart and Costco are actually offering better products and catering to higher income customers? Is that really what's going on?
That's exactly right. And you could have said it, you couldn't have said it better than what you just said. Think about Aldi. Aldi is coming up in social influencer circles about the quality of their organic private label. Aldi is a channel, in theory, for lower income or lower value shoppers, but yet they're getting the credit for high quality private label. That's the shift that's changing. That's what these retailers are slowly accommodating to.
So the Walmart signal that people used to look for, that when they did well, everybody else did terribly, and that meant the economy was tanking, has that been ultimately broken?
Big time. So we call this thing the funnel, and we look at how much incremental share is Walmart taking of overall retail spending. That number is roughly, call it 10 cents on the dollar. Amazon's a whopping 30 cents on the dollar. So together, they're taking 40 cents of every new dollar. Walmart's doing that. It's not because their core customer is suddenly wealthier. It's because they're getting more share of a middle and upper income customer naturally.
Yep. This is the argument that Lisa's made repeatedly over the last few months. Is that why Simeon's here, to validate your views on
retail? Thank you. I appreciate that. It was really well done.
Hey, Simeon, thank you. I appreciate it. We've just got to fix that line at Trader Joe's.
Yeah.
You know, on the weekend.
Oh,
but they're quick. They move quick.
Doesn't matter.
Sort of
It just makes you feel like you're like, what are you doing with your life?
Hate it.
Yeah.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
My name is Konstantin Stefana. I am the owner of a family office and the company called Company I Limited. I also have a live streaming channel for startups. It's SG Trader, so we let startups to pitch investment community on our channel. I give them 3-minute pitch. We publish their video on our channel, and everybody who is interested, please welcome to send me your video, and I will roll for almost a month your video for all financial community. The channel is live, it's streaming live 5 days a week, from morning to night.
other thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
To kickstart the European Trading Day, live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
The Fed's more than likely to go through neutral, to go from a restrictive stance on policy to a stimulative one in the coming year.
At the Fed, a big piece of the caution is they are, to their core, data-driven in their monetary policy. And we know data are messy.
The market looks very convinced that a cut is coming.
Markets are very certain about December being a cut, and they're pretty certain about January being a pause.
Starting in the first half of next year, you could see the Fed, not explicitly, but implicitly start to signal pauses.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
I missed you too. Thank you for the warm welcome back. The third hour of Bloomberg Surveillance starts right now. That was to you. You said you missed me, and it took me a while to get back to you.
It took you 2 hours to get back.
After 2 hours, I missed you.
Well, I missed you too. I'm really glad you're back.
Equity futures up by about 0.2% on the S&P. On the Nasdaq 100 up by 0.4. A 4-week run on the Nasdaq 100. The S&P 500, the biggest weekly loss in about a month. Small caps suffering for 2 weeks. Then we've got to sit on this, Lisa, and just talk about what's been going on and what hasn't happened since the election. What we thought would happen, what a lot of people came on the show said would happen, was that the equity market rally would broaden out. The small caps was a place you wanted to be, and for November it certainly was. Big move higher. Since then, though, just over the last couple of weeks, big tech starting to reassert itself. Small caps starting to struggle. The trades that people thought would work into year-end and beyond starting to stumble.
The big reason why has to do with the bond market, basically. You saw yields going higher. Initially, they went lower. Initially, people said, actually, Trump administration's agenda won't necessarily be as inflationary as we thought. Okay, maybe we're going to see lower yields. And then that all started to reverse. And I think that was the big shift where suddenly people said, wait a second, the inflation might be a lot stickier. That might be reflected by the Fed, and that might undermine some of the story for the small caps.
Last week happened, 24 basis point move on a 10-year, around 26 basis points higher on a 30-year. This morning, across the curve, yields come in by a couple of basis points. We're down about 2 or 3 on a 10-year. We're down 2 on 30s. All of that going into retail sales tomorrow morning, and the big one on Wednesday, the Federal Reserve. Overwhelmingly, the consensus is a cut and then a skip. Will that skip turn into a pause?
At a time when really there are so many uncertainties. how much are they actually going to give us that information, and how much are they going to give us a framework of how they're going to be judging policy? To me, I want to understand what their scenario analysis is at a time where they say they don't want to make projections, they don't want to make assumptions. Okay, then what are your models? How do you even begin to try to understand this at a time when a lot of the previous ones seem to be kind of broken?
This was what Bill Dudley had to say last week. This idea that they should be starting to assume some things, because the financial markets as well have baked a lot of this in. Two things come to mind. Will he talk at all about what extending TCJA could mean? Those are the tax cuts. And also potentially what tariffs can mean. Oxford Economics, out with research today, talking about how actually businesses in their survey are starting to get a lot more nervous about what the tariffs might look like and how it might impact their bottom line next year.
The problem is you've got to make more than one assumption. You've got to make an assumption on what policy will look like. You've got to make another assumption on what that policy will do to growth and inflation. And there's a real debate, I think, on Wall Street about that. We caught up with Steve Chevron of Federated earlier on this morning, and Steve made the point that he thinks people are overestimating the inflationary outcome off the back of some of these policies and underestimating what could happen to growth.
And a lot of that comes down to people don't understand, or don't agree, I would say, on exactly where we are now and how inflationary the moment we're in now is. You look at, say, the inflationary read last week. Some people say, it's just because eggs got expensive. Other people say, you know, look at housing market. The prices are coming down. And other people are saying, look, there still is tightness in the labor market. You could see that from a higher, just a headline number on the jobs figures. And you have to look at that as well as some of the investment and go to that instead.
Chairman Powell, the main event later this week. Equity futures right now on the S&P up around about 0.2%. Coming up this hour, we'll catch up with Sarah Hunt of Alpine Saxon Woods as markets brace for the final Fed decision of 2024. We'll speak to Tom Naran of RBC with Tesla sitting near all-time highs, and Mona Mahajan of Edward Jones on why animal spirits are only just awakening. We begin this hour with stocks higher and investors looking ahead to Wednesday's Fed decision. Sarah Hunt of Alpine Saxon Woods looking to next year, writing sticky inflation and some unknowns in the labor market given the last few months has already tempered market expectations for rate cuts after the December meeting. How the data shakes out in the beginning of the year may be a driver for markets absent a clear path. Sarah joins us now for more. Sarah, good morning. It's
good
to see you.
Good to be here.
Let's reflect on the last 12 months before we talk about the next 12 months. I remember coming into 2024, it was 6 or 7 rate cuts, then inflation data happened in the first quarter. Then the first quarter's inflation data was a bit of a head fake. Then the summer's labor market data happened. And then the labor market data of the summer was also a bit of a head fake. I think we've had 4 different versions of a different story through 24. Is 25 going to be any different?
I don't really think so, because I think the reason that you had all those different narratives in 2024 was because we make all these big assumptions, we chart a linear path, and then the data says, no, we're not going to be that linear. I don't think that that's going to change. I think that you have seen cross currents both up and down, and I think that there are some things to be concerned about on a variety of different fronts. So I just think that the lack of a clear path is probably going to be continuing.
That screams retain optionality at the Federal Reserve. How do they go about doing that this Wednesday?
It's an interesting question, and I think that the way that they present it is going to be important, but I think that whether you call it a skip or a pause, I think that the recent inflation data, the baked-inness of December, probably means we get 25 basis points this week, and it probably means we set ourselves up to say we're going to look at it meeting by meeting. However they want to phrase it, I think it's going to give them room to say maybe we need to pause or maybe we need to skip. But I don't think that anybody wants to talk about reversing course yet, so I think that it's important to say this is the direction we're heading in, but we need to make sure that we're not going too fast so that the data doesn't undercut it.
So far, we've seen the market bake in the expectation for a skip. We've seen this idea that the market expects a slower pace of rate cuts for the Federal Reserve. Have equities fully understood this in their valuation?
I think equities are going to go. Now they're just going to keep cutting them. And I think that's where equities are right now. But baking in a skip, to John's point earlier, we've baked in so many things that have been unbaked in the cake later that I don't know that what that actually, how meaningful that becomes, that expectation, unless it's right before and you change it like 24 hours.
Okay, I guess that the other way of asking this is, how different are the views right now of the economy and markets between the bond market and the equity market?
I think they're pretty different. I think the bond market is getting worried about the fiscal picture. I think the bond market is getting worried about the concerns that we have about all of a sudden we're starting to get into a fiscal fight right before, hopefully not a physical one, right before we get into the beginning of a new administration, right? You've got all this stuff that we punted in September that we are going to have to contend with. And the equity markets are going, hey, growth is pretty good. We've got these great new technologies coming out. I think that the quantum computing chip by Google was a big deal for the markets to have another thing to hang their hats on in terms of the growth that's going forward, right? The AI story is playing out. The infrastructure was being built. Now people are using it. It's starting to save them money. And so we need something new. So that adds a new layer. And equity markets are looking at that and going, great, things aren't that bad otherwise. And bond markets are going, oh, there's all these things that I could worry about, which is typical of those two splits, right? So I think it's a little bit different.
So a month ago, the rally was going to broaden. A month later, it's not at all. Breadth is negative. The Nasdaq's still ripping. What gives? What's behind that?
I hate to say this because I want to see the market broaden, but it's almost like it's Europe's year, right? It's not. The equity markets are not broadening out, and every time they do, something scares them because that scaringness, that's about growth, and it's about growth on the smaller side. It's not about the big tech guys growing. It's about, is the economy going to be okay? Do we get growth? And are rates going to come down? As rates were ticking up, I think that trade reversed. Do I think that it will broaden out if the economy is good? Yes, it should, but it does have a lot of stops and starts.
Do we keep getting squeezed into fewer and fewer things as investors? Are you seeing any signs of that?
I think we are. I mean, I think that's where the big tech names, when they start to re-rally again, everybody kind of has a little bit of relief because everyone's still in it. No one got out and said, I'm going to switch wholeheartedly to this. They just said, I'm going to up some exposure here because that's going to make some sense as we go down the road. But no one's selling off all their big tech names.
We talked to you a couple of months ago about why you were bullish on energy. And I want to go back to that because, to John's point, a broadening out in themes at a time when everyone was hoping that we could chase the new theme, that was something that Mike Wilson talked about. How much are we just in a sort of holding pattern right now, where people are still debating what the biggest offsides risk could be to hedge against? In other words, the idea of oil being an inflation hedge, the idea of bonds being some sort of downgrade to growth threat. How much are we still in this question mark around which really is the biggest threat?
I think we are, and I think that, I mean, if you want to talk about where markets are differing, the commodity markets are going, no, growth isn't really very good. The commodity markets are telling you that there's not an expectation that there's going to be bigger demand, right? You've seen retail sales out of China this morning that weren't that great. There's a global issue on oil, and whatever's going on in the Middle East, no matter how fractious it becomes, doesn't seem to have a big effect on the energy markets. And I think that that's one of those quiet things that if it becomes a problem, becomes a very big problem very quickly. But I've been perennially bullish and perennially wrong on energy because even though I think that the infrastructure is important and has value, and you have seen a re-rating in those stocks, it's still not getting what I think is the respect it deserves. But that's very, very on the margin. The minute people think growth is slowing down, they're like, let's sell this whole area. So I think it's hard to see where those biggest problems are, but there's a fight right now in different sectors about what's actually going to happen. And the technology sector is going one way, and a lot of other sectors are going the other way.
When it comes to energy, though, the fact of the matter is, in the retail sales out of China, it's just a Chinese demand issue. It's because China is slowing. So doesn't that basically just signal that we are going into more of this tripolar world, as Jay Ploski would say?
Well, I think that yes, there's an issue internally, but there's a big driver there, right? Not just for their own goods and services, which they are trying to inflate. They'd rather see more Chinese goods and services be consumed in China. But there's also, I mean, there's a big commodity piece to that, too, that when things are slower there, there's less demand globally for commodities. So I think I think we are getting into more of a polarity that as opposed to a whole continuum. And you can look at Europe on the lower end of that right now, right, too? So I think that is important as well. But it's also, I mean, we're just looking to see the excitement in one area versus the non-excitement in others. And I think that's right now what the market is struggling with, and that's why the sector disparity is coming back.
What are you so worried about for next year in terms of the policy questions?
Oh, I'm worried about a lot of things for next year. I think the biggest problem really is the fiscal situation, right? So we have had, post the financial crisis, when you took interest rates to negative or zero, people got very comfortable spending a lot more money than we have. And now all of a sudden, there's a part of the budget that is now interest expense. And that hadn't been a problem for a long time. So we're talking about trying to be more efficient and cutting government. We couldn't agree on anything. And now we have some other expense that we have to pay.
It's a big part of the budget.
It's a big part of the budget. So I think that if I'm concerned about something of how that works, it's how that impacts policy decisions and what people are able to do. And I think that right now the market's baking in some things that they think are that it thinks is very positive. But I also think that there may be a delay in some of that legislation that people are not counting on because of the fiscal situation.
You've talked about how there's a divergence in markets and how it's being expressed in a number of different ways, about how people are leading into the growth story of tech and not necessarily worried about some sort of surge in inflation or the idea of some sort of dramatic downturn. Which do you agree with? I mean, are you leaning into the bubble? as John was mentioning, or do you just sort of play the contrarian wagers about either an increase in inflation or a fall off in growth?
So personally, it depends on the day, right? But professionally, you have to look at this and go, okay, if I think, I want to make sure that my portfolios are managed in a way that I'm comfortable with under a variety of scenarios. That's our job, right, is to look at the probability scenarios and go, am I comfortable with where we are? So you want to make sure that you don't get out of that tech entirely. You want to make sure that the valuations on the companies that you're holding are reasonable, because one of the things that you can be concerned about is just valuation multiples, right? Because all of a sudden, are we re-rating forever to these higher levels? Or is at some point, I don't know that we're coming back to what you considered a traditional level for PEs for pick the sector, but I think that we're pretty elevated in some places that are high enough that you could be concerned. So you want to make sure that you are looking at those probabilities and saying, I'm comfortable under this scenario and that scenario. So I think that you have to be able to hold both in your forward-looking thought process. Otherwise, it becomes difficult to invest.
Just before you go, top pick for next year. What is it?
Oh, that's a tough one. I would say I still think that the energy infrastructure is going to have a place for investors, and it's cheap right now, and you've got good yields, right? So look at pipelines. Look at companies that play into LNG. Look at companies that play into some of the things that are split, but also some of the things that continue to have traditional hydrocarbons.
Sarah, appreciate your time. It's good to see you. Thank you. Sarah Hunt there of Alpine. Saxon Woods. Equity futures this morning, positive across the S&P 500 and the NASDAQ, with an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Volkswagen's talks with labor leaders entered their 5th round of talks today. The two sides are still deadlocked on how to cut costs to make the brand more competitive. 2 days of negotiations have been planned, but if there's no breakthrough, the union will hold a vote at the end of this week for 24-hour walkouts in January. In a statement this morning, Honeywell says it's weighing a possible separation of its aerospace business, along with other strategic options. Last month, Elliott Investment Management called for a breakup of the industrial group. Elliott welcomed this review, saying Honeywell is on the right course. Last month, the activist investor revealed a more than $5 billion position in Honeywell. Starbucks is boosting paid parental leave for in-store workers. The company announced birth parents will receive 18 weeks of paid leave at 100% of their average pay. That starts in March. A parent who doesn't give birth will get 12 weeks. Previously, the company offered retail workers 6 weeks of paid parental leave and as much as 12 weeks of unpaid leave. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the morning calls, plus Tom Naran of RBC as Tesla hits a record high. That conversation is just around the corner from New York. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Counting it down to the open in about 1 hour and about 13 minutes away. Equity futures on the S&P 500 doing okay, up 0.25%, and a rally returning to the bond market. Yields are lower by 3 basis points on a 10-year, 436.52. Let's get you some morning calls. First up, Barclays raising its price target on Broadcom to 205, saying its AI story remains intact despite a near-term transition. That stock is up by 2.8%. Your second call from Jefferies, downgrading Ford to underperform, noting inventory concerns and looming decisions about its European presence. That stock is down by 3.5%. And finally, Wedbush raising its price target on Tesla to 515, saying Trump's White House is a total game changer for the EV maker. That stock is up again this morning by about 0.9%. Let's stick with Tesla, the EV maker surging over 70% since President-elect Donald Trump won the election, hitting another record high in Friday's session. Joining us now to discuss is Tom Narayan of RBC, who has an outperform rating and 313 price target on shares of Tesla. Dan Ives making you look bearish, Tom. I'm sure that wasn't the objective. Tom, talk to me about what you think we're still underestimating about what we might see from Tesla in the years ahead.
Yeah, I think there's a couple of things happening. One is you'll get your affordable car at the beginning of next year, the sub $30,000 car. A lot of folks think that it could be the same aesthetic as a Cybercab, which I don't know about you, I think it looks kind of cool. And what if that has FSD version 12.5, even 13 on it? You know, I'm marketing in Europe this week, and a lot of folks are asking, sub $30,000 car with FSD, why buy any other car? So there's some catalysts there. And then obviously, if they get unsupervised FSD approved, I mean, upside is tremendous. So, I mean, you could do the math on robotaxis and get to like $10 trillion of total global market and have them get a small share of it and justify, you know, a much bigger price target. I'm not doing that just yet.
Sure.
But the upside potential is significant.
The outlook for them seems to be so much better than some of the legacy players at the moment, Tom. They're at an all-time high. Ford is down this morning. I want to share that note from Jefferies with you. Downgrading Ford to underperform, noting inventory concerns and looming decisions about its European presence. You're in Europe, I believe, at the moment, Tom. What are you learning about what's happening there? What are these US players doing in a market where we've seen downgrade after downgrade from European players?
Yeah, it's interesting. The best place to come to learn about what's happening, especially in Germany, is Frankfurt, and to talk to the investors who really are more plugged in than any of us are. And I will say there's some green shoots happening. I think because politically the possibility of more right-wing politics, especially in Germany, winning, could mean actually that the CO2 regulatory cliff next year might actually get delayed after all. So we're hearing more positive news there. Now, it's not all names are treated equally. The one name we're hearing the most that could be benefiting the most from different fundamentals and secular trends is BMW, actually. That one's getting a lot of interest. So the main kind of phrase I heard was not like getting bullish, but less negative. So that's kind of what I would say about Europe.
That's incredible, and I think a lot of people will cheer less negative at this point, especially from some of the European auto manufacturers. I want to put the stories together, though. The idea of, we're talking about the optimism around Tesla and some of the investments, and then you talk about this question around Ford and getting rid of legacy aspects in Europe and trying to shore up some of their profitability. How do some of the legacy companies, whether it's Ford, whether it's Volkswagen, both invest in the future, right, which might be FSD, full self-driving, as well as certain innovations, while preserving their current sphere, right? I mean, has there been some hack that's been established for any of them that seems promising?
Yeah, I mean, the one that sticks out is GM, right? Look what they've done, right? They took a big impairment charge in China, and all indications are they're evaluating that business. You know what's going on there. They sold the one of their battery plant JVs to LG, and then obviously the big news, right? They came out of robotaxi, but now they're going full steam ahead into Super Cruise, their FSD type competitor. So it seems like what the legacy OEMs could do is pivot a little, right? If you're going in all these different directions, let's retrench and put our money into what people really want. I think there's a big push for level 2+, what Tesla FSD does. I was at a Mobileye event recently or last week, and they're saying they're getting a lot of interest from legacy OEMs who want to use their product, because if Tesla has this FSD product and other OEMs don't, they need to keep up. So that one seems to be where investments are, and maybe you can pull away from doing some of the other ones.
Tom, that was where I was kind of going, was this question of partnering with other outside firms that are coming up with new technologies. This idea that maybe it doesn't make economic sense for some of these companies to do it themselves. How much is that the path ahead, and which are some of those companies that are really benefiting the most?
Yeah, that seems to be really where, I mean, look at what happened with Volkswagen, right? They went with Rivian for software-defined vehicles. They went with Mobileye for this FSD-like software. That's the one that everyone's kind of looking at, that potentially Mobileye could be a big beneficiary if companies want a level 2+ offering. Yeah, and then some of the suppliers, like an Aptiv, which does some of the wiring for electrification and some ADAS. Magna's another supplier that does some ADAS. So, you know, it makes sense that instead of putting your hard-earned cash, that if you're concerned especially on higher dealer inventories or et cetera, maybe it makes more sense to outsource that instead of trying to vertically integrate. So yeah, there's a number of suppliers that could benefit, and you have to look at the secular trends. Electrification's one of them, that's kind of slowing a little, but ADAS, that's the one. Assisted driving, level 2+, that could be the place. I think we're going to see some more investments.
Tom, when it comes to legacy auto companies, last week we heard from Mary Barra speaking to Axios, and she said a federal regulatory framework for self-driving cars, something that Elon Musk is pushing the incoming Trump administration to do, would be better than state-by-state patchwork of regulations. While they may be jealous of the first buddy and his proximity to power, will he lift all boats when it comes to potentially some of his influence on the incoming policies?
Yeah, I mean, I do have to stress, though, that while getting federal framework on self-driving is definitely a positive, you can, you know, GM wanted to get that Origin car that doesn't have steering wheels and pedals and had to scrap it because it was getting difficulty. Now it seems like it could. Let's not forget, robotaxis are a very local business model, right? So states, municipalities have to approve. So while it is at a very high level positive to have the first buddy, let's say, let's not forget, these guys have to get approval. You know, maybe Tesla rolls out in Austin, a friendly city, but what happens in California, right? There's some friction there. Will they have to put LiDAR in those vehicles? So the federal friendliness doesn't necessarily mean federal deregulation, approval of robotaxis. It just means at a high level that probably the sentiment is getting more positive.
Hey, Tom, enjoy London. It's got to catch up. Tom Moran there of RVC on the European auto market. Just to begin that conversation, BMW, VW, down by more than 20% in 2024. Stellantis is down by close to 40%. It's been brutal for many of these names.
Yeah, and it's sounding less negative because potentially there could be a removal of some of the regulations, at least in the near term. This bar is getting lower and lower, which is the reason why some people are getting bullish.
It doesn't take a lot. It doesn't take a lot to change things. We talked about this earlier this morning. Very little needs to go right to push this market in a different direction. Up next on the program, we'll catch up with Lydia Basor of EY and Mona Mahajan of Edward Jones from New York City. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
So some pushback from Andrew Honhorst of Citi. You might expect that. He just published. Risks are skewed dovishly as markets are running with a no-landing narrative despite the last 2 weeks of data showing both job growth and core inflation are slowing. He is not in the Matt Lazzetti of Deutsche Bank camp. Matt Lazzetti, of course, is expecting a rate cut this week, and then the Fed's going to be on pause for the whole of 2025. Andrew's pushing back against those views.
I would push that further and say that pretty much all of the guests on Team Surveillance this morning have basically been talking about that same type of dovish surprise, whether it's Steve Chivarone, we heard from Kelsey Barrow over at JP Morgan, all of them talking about how maybe this market has taken it too far, that we're not going to get the disinflation that we had expected 2 weeks ago. I wouldn't be surprised. I mean, we could just come up with another narrative in 2 weeks, and then another one 2 weeks after that.
Tomorrow after retail sales.
Let's do that.
Who knows? The bond market starting the week rallying just a little bit. We're down 3 basis points on a 10-year, 4.36. On a 2-year, we're down 2 to about 4.22. In the equity market, here's a snapshot of things for you. Equity futures on the S&P 500 pushing higher by a few tenths of 1%. We're up a third. We're up 0.6 now on the Nasdaq 100, following 4 weeks of gains for mega cap tech in America. 1 hour away from the opening bout. Let's get you some morning movers. Let's check in with Manus Cranley. Hey, Manus.
Jonathan, we've got Honeywell on the board, bid this morning up by 2.36%. How do you deliver for your institutional shareholder, your activist institutional shareholder that has a $5 billion holding in you? That is, of course, Elliott. You use brilliant words. Transformational changes, unlocking shareholder value, read shake-up, read divestment potentially of the aerospace business. What is the growth in aerospace? About 7% per annum over the next couple of years. So it is about extracting value from the assets that you have. So it's the classic PR release, but this is about sating the need of the activist investors. This is a company which sliced its sales outlook by $400 million just a few weeks ago, cut the free cash flow by over $500 million. Elliott wants extraction. Ford on the downside, Jeffrey says they're going to face perhaps one of their biggest existential questions to resize, if not exit, from Europe. The gap widens between warranty provisions and the related cash outflows. So there's pressure in Ford. By the way, you've got the most amount of underperformance AKA cells since 2009. So you're looking at a $9 target from Jeffries on that. Leaving the snapshot on Capri, this is all about affordable luxury. Where does it go? How does it get split up? Where does it get sold off to? The two brands are Versace and Jimmy Choo, held within this family, which is Capri. We understand that they have appointed bankers to either sell as one-stop shop or split it up. Of course, that's after the Tapestry deal failed to materialize because of a number of legal reasons just a few months ago. Jonathan.
Manus, thank you. That stock higher by 4.6%. A lot of people have struggled with that story, including myself over the last year or so. What can and what can't get done under the Biden administration, of course, is an exercise that's not worth having now because there won't be one in the next 4 years or so. But ultimately, just reflecting on the last few years, it's been kind of bizarre, hasn't it?
Very heavy when it comes to antitrust policy, which is why you saw a ton of M&A deals fall through, and then a lot of people saying we're just going to wait on the sidelines. And now you think there's animal spirits in financial markets, there's animal spirits when it comes to potential M&A deals.
We've had this conversation a lot through the years so far, and I keep reflecting on an interview that we did with Brian Moynihan at Bank of America over at their headquarters back in February, March time. And he basically told us that there were a lot of people that wanted to do a deal, but didn't know the kind of deal that could get done would pass scrutiny down in Washington, D.C., and that's why they weren't even coming to the table and closing one, or even talking about having one. And I wonder how much that changes in the next few months.
How much that's already changing as people sort of set up for next year. Key question to me will be, who will be the test children who will come out there and really figure out what's allowed in the new administration? It will be different, but there still will be restrictions, particularly around certain types of tech transactions. So that's going to be an interesting trial balloon that's put out there.
Is tech the first place you'd look?
Yeah, I think so. I think, I mean, where would you look? Handbags?
Media as well.
Airlines?
Yeah, especially
Think
after
about Spirit.
gone on.
Would Spirit be filing for bankruptcy if that deal was allowed to go through?
True. And we talked about it at the time. Some of these things just did not make sense at all. And here we are. Looking ahead to the Federal Reserve, as always, it's what we do here. Traders are waiting for the Fed's final decision of the year. That comes on Wednesday. Lydia Basura of EY writing, given cooling labour market conditions, strong productivity growth and moderating inflation trends, we continue to expect a rate cut of 25 basis points at the December meeting. Lydia joins us now for more. Lydia, welcome to the programme. It's a three-part act, as you know. It's not just the decision, it's also the news conference, but we also get the economic projections in the SEP. And I wonder, when you look across CPI, when you look across growth and unemployment, the changes that you and the team were expecting this Wednesday, what would those changes be?
Good morning. So when we look at the summary of economic projection, we are expecting to see, the dot plot showing 3 rate cuts next year instead of 4, and another 2 rate cuts in 2026. We're also expecting to see an upgrade to GDP growth. We had 2% in the September projection. We're likely to see now 2.4% by year end for GDP. For the unemployment rate, we're likely to see it nudge down to 4.2%. And then, also inflation moving higher, given the latest numbers and the inflation stickiness that we've seen in the recent months. So we're likely to see 2.8% for core PCE, up from 2.6%. So really a reflection of this environment where inflation has been a little stickier and growth has been holding up fairly well.
Lydia, that last point is the important point. It's reactionary. We're marking to market. How much of this is going to be anticipatory, anticipating the changes from Washington, D.C.?
Yeah, I think we have a dot plot that's going to be useful in terms of providing a path and a view of where the interest rate trajectory is heading. But we also have, as we know, a Fed that's extremely data dependent. So part of this is likely to reflect essentially what we've seen in the data, the data that has been coming in essentially.
Meanwhile, we're talking about some of the ways that Wall Street is gearing up for next year, regardless of what the policies are. I mean, we're talking about M&A, and I'm just wondering, as an economist, given that we are expecting a surge in mergers and acquisitions, do we understand the economic impact of that, whether it comes to either efficiencies of scale, whether it goes to increased productivity, whether it means increased layoffs? Do we have a sense of that?
Yes, so I mean, when we look at the economic outlook next year and what we're seeing in terms of business sentiment, we are expecting to see an upside from a more business-friendly environment and a turn in business sentiment, and we do think that that's going to have a positive impulse on growth, a modest positive impulse on growth. Now, when we look at the broader economic outlook, that's going to be offset by some of the other policies that are going to be put in place when we think about immigration, when we think about trade policy and the potential for tariffs. We're likely to get a drag from these policies, and that's going to create an offset. So when we think about the outlook in 2025, 2026, we do think that, when you look at all these moving parts, we're likely to see GDP growth slightly lower. So we have a modest drag from all of these policies, but there are a lot of moving parts, and some of these impacts are going to be offsetting each other.
What are you looking for, Lydia, on Wednesday when we hear from the Fed, given that they're probably not going to give a whole lot of guidance as to their predictions for 2025? What guidance can they give us?
Yeah, so, I mean, when we think about the policy assumptions, I think Powell is going to be sticking to this idea that we don't guess, we don't speculate, and we don't assume. So this idea that they're not going to be putting any policy assumptions into their forecast. I think when you think about Fed Chair Powell and how he's going to be setting the stage for a pause, which is, our base case in January, I think he's going to be relying on this idea that the economy is in a good place. Inflation also has been a little bit stickier And the fact that the Fed is essentially going to be moving in this dark room full of objects, so this idea that they need to be moving a little more slowly, I think that's the message we're going to be getting from Powell, and that's because also he won't be able to, highlight the inflation risk from all these potential policy shifts that we're going to get from the incoming administration.
Well, putting these two stories together, how much could stickier inflation not just be an annoyance for Jay Powell, but also be difficult for M&A and deal making in 2025 and 2026?
Yeah, I mean, this is a key risk in terms of the inflation upside from higher tariff and from stricter immigration. When we think about the inflationary impulse, and we've done some scenario analysis around some of the proposals, and the latest one, which is the 25% tariff on Canada and Mexico and the 10% tariff on China. And we're looking at an inflationary impulse in 2025 of 0.4 percentage point on inflation. So that's going to be a key risk. And we've also baked in a trajectory for inflation that's going to be modestly higher. Now, as you know, there is a lot of uncertainty surrounding all these policy shifts. And that's also the reason why the Fed doesn't want to make too many policy assumptions, around tariffs, but also around immigration as well. It's really a wild card for the economy in the next 2 years.
You've done a lot of work on the M&A activity we could see, and you say it's expected to rise 10% just next year alone. Who's going to be the biggest winner?
Yeah, so we're expecting to see a rebound in activity, and it's really on the back of this, continued positive economic environment. We have less uncertainty as well. If you think about where, interest rate is heading, where the Fed is heading, where inflation is heading as well, there is a bit more visibility. And, in this post-election environment as well, as we talked about, this more, business-friendly environment, there is, some potential positive impulse. We also have interest rates gradually move lower. So, the outlook, we are, positive on the outlook in terms of seeing that rebound in activity in 2025.
Hey, Lydia, appreciate your time. As always, Lydia Basoda of EY going into the Federal Reserve decision on Wednesday. US retail sales also tomorrow morning. Jim Reed of Deutsche Bank's just published their global market survey for 2025, just put out the results. There's some interesting bits in here about policy in Germany, in the United States, on tariffs, etc. I'm very interested in the comparison between the United States and Europe. So I'll pick out a few points here from their survey. Only 2% believe US growth will be below 1% in 2025, and that's the average expected in Europe. Nobody saw European growth in 2025 above the average expected in the United States, which is absolutely amazing. And they also say this: US long-term inflation expectations are the highest in a year, but in Europe, they're the lowest since Q2 of 2021, which speaks to this very different conversation that we're having regarding the ECB and the Federal Reserve.
This screams of parity. I mean, this screams of basically everyone shorting the euro, because there is nothing in here that leaves anyone at all excited about the idea of anything in Europe, A. And B, has the divergence ever been wider? And that, I think, is a really important note.
But maybe one point which will help Europe is he says the base case that investors think Trump will be a bit less aggressive than his campaign promises on trade. So maybe that's a window and an opening for at least Europe, where it won't be as hard when it comes to tariffs. The issue, of course, Europe is going to have is if they go up on China, China's only going to have one place to really start dumping.
I'd actually say that reinforces the view of why I'd be even more worried about Europe. If these are the numbers they expect for European growth with a less confrontational Donald Trump,
True.
I wonder how much worse the outlook would be otherwise. I also have to say this is a good snapshot of where expectations are. And I'd go back to something that we talked about earlier on this morning, how little needs to go right in Europe to change the story a whole lot more. If you take this note from them, only 2% of German responses think the debt brake will remain completely unchanged. The number is notably higher outside of Germany. Just how big a change could we see in some of these places?
If Germany borrows any more than they already are, if they're basically more amenable to the idea of increasing that deficit in the short term to invest in real projects, how big could the boost be to some of the asset prices, especially when paired with an ECB benchmark rate that's lower? When I talk to people, the most contrarian bet right now, I mean, this is almost consensus at this point, go long China and then go long Europe, because they're going to have the twofold low expectations and a central bank that's going to be easing much more considerably.
Take a snapshot of things right now. Equities just about positive by 1/3 on the S&P. On the Nasdaq 100, up by 0.5 in the bond market. Some real disruption through last week. Yields higher across the curve by double digits on a 2-year, a 10-year, and a 30-year. On a 10-year and 30-year piece of the yield curve, we were higher by more than 20 basis points. At least this morning, we're down about 3.
Yeah, last week was the biggest increase that we have seen in the 10-year yield going back to October of 2023, at a time when no one can really give one reason as to why. I mean, basically, it's just the feeling changed. And the feeling was a stickier feeling. And those feelings will get discussed on Wednesday.
Vibe shift is a quote that I've seen in so much research. There's just been a massive vibe shift over the last month. Mana Mahajan of Edward Jones looking ahead to the animal spirits of 2025, writing, investor sentiment is heating up. And as the bar of expectations keeps rising, it leaves potential room for periodic disappointments. Mona joins us now for more. Mona, welcome to the program. Embrace the bubble was a noteworthy headline over the weekend in Barron's Magazine, a magazine I typically enjoy over the weekend. Mona, your view on that? Should we be embracing some areas of the market that have looked frothy, but it's been expensive to bet against it over the year so far?
Yeah, thanks, Sean. You know, look, it does always feel like markets can run to the upside and run to the downside beyond what most investors usually expect. And so in this scenario, we're still looking at a market that is underpinned by solid fundamentals. So we're looking at an economy that is still expected to grow in Q4 by 3.3%, according to the Fed GDP now. We're looking at a Fed that is still moving in the right direction. It's moving rates lower. And by the way, earnings growth is expected to be double digits, perhaps 10 to 15% in 2025. So the underpinnings are in place. The backdrop looks pretty solid. Markets, though, have run quite a bit. We know we're at a 27% clip higher in the S&P 500. Could we have more gains ahead? Perhaps, but we do see more volatility and more bumps along the way as well.
Mona, is the U.S. the only game in town, or is it starting to shift as the expectations have already been borne out in the price in the United States and not so much elsewhere?
Yeah, look, the U.S. exceptionalism story, we think, still has some legs here. And parts of the market do look frothy. Perhaps valuations have been extended, and we know what's going on with mega cap technology and that Magnificent Seven. But the parts of the market that haven't really seen a lot of valuation expansion, you look at the broader S&P equal weight index, still trading around that 17 to 18 times forward multiple, not stretched by historical metrics. You look at part of the value and cyclical parts of the U.S. market, even looking down to the mid-cap sector in the U.S., not stretched historically from a valuation perspective. And so we think there are still opportunities for that U.S. exceptionalism to play out. Keep in mind, those parts of the market are typically more domestically exposed as well. They have more U.S. exposure than, say, the mega cap technology parts of the market as well. So they could continue to perform, in our view.
The past 2 weeks have been sort of a little bit of a fly in the ointment to that story, because that really was the story in November, this idea of the broadening out. And then last week, we saw a real outperformance of big tech. And a lot of people said it was simply because yields were higher. How important is it for yields to keep creeping lower, for the disinflation story to remain intact, to keep that thesis in place about a broadening out?
Yeah, you know, look, a contained inflation story is essential to this economic backdrop to continue to play out. If inflation remains in what we think will be kind of a 2 to 3% range next year, the economy can hold up pretty well in that backdrop. We've seen that this year as well. If we start to see inflation move beyond that, which we don't see in a base case getting back to anything in that 3, 4, 5% plus range, that's where we start to hit real kind of roadblocks in the economic growth picture. And we know what underlies kind of cyclical growth, cyclical parts of the market doing well, is the economy continuing to do well as well. So we think from a consumer perspective, the important part of this story also is that wage growth continues to exceed inflation. So folks are taking home real wages, which is helping the consumption story. That is all part of how the broadening of market leadership continues to play out. There will be ebbs and flows in that story, but we think generally diversified portfolios will continue to be a winning strategy as we head to the next 12 to 18 months.
Well, Mona, when it comes to ebbs and flows, JP Morgan's head of global market intelligence was talking about the fact that there's potential for a pullback in mid-January around the time of the inauguration. Are you expecting a lot more volatility early on in the Trump administration?
Yeah, look, there's a lot of eyeballs on what the administration will do on some key variables here. What is their tariff policy going to look like? Will they go to the more extreme proposals where it's across the board 10 to 20% and even more so in China? What is the immigration policy going to look like ultimately? Will they have or implement some sort of supply shock to the labor market? And then, of course, the tax.
I think we've lost the line there with Mona Mahajan of Edward Jones looking ahead to next year. Okay, I think that has gone. Diversified, broadening out the rally. We've heard a lot of that. It's just not working over the last few weeks.
I thought you were going to say diversifying of the broadband, because I have to say
it's
that's
diversify
part of
that too.
We're going to diversify
Cable
that.
providers.
Exactly. Well, we've been hearing a lot of the diversification story. I want to diversify my bandwidth. I was having trouble with it last night too, so I relate.
With your cable, your broadband.
It has to be because of the drones.
I think so. I think you're right.
Oh, right, yeah. New conspiracy theory.
100%. They just want to disrupt
like
our
that.
cable.
Hey, you've got a theory that John Kirby doesn't have, because he's not sharing anything right now, right?
Maybe,
no one knows anything.
If you want to join us and talk about your cable connection and how that's a problem, John Kirby, you're welcome to come on
Particularly in the
anytime.
New Jersey area. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Luigi Mangione, the suspect in the killing of United Healthcare CEO Brian Thompson, has retained a high-powered New York attorney and former CNN legal analyst to represent him. Karen Friedman Agnolfio will represent Mangione as he faces a second-degree murder charge. Mangione remains in jail in Pennsylvania, where he was arrested last week. Manhattan DA Alvin Bragg said that there were indications that Mangione may waive his extradition. Cocoa futures hitting a fresh record high in New York as trading supply concerns grow. The rally increases odds that the already high cost plaguing chocolatiers and consumers will worsen. Weak harvests for the commodity in West Africa have plunged the world into a supply deficit. And LeBron James returned to the LA Lakers last night in a 116-110 victory over the Memphis Grizzlies. James missed 2 games dealing with a left foot injury and was away from the team most of last week because of personal reasons. James had 18 points, 8 rebounds, 8 assists, and 5 turnovers in 34 minutes of play. The Lakers are currently 14-12 on the season. And that's your brief. John.
Danny, thank you. Thanks for this morning. Up next, setting you up for the week ahead, live from New York. This is Bloomberg.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The opening bell around 36 minutes away. Equity futures on the S&P up a third of 1%. On the Nasdaq up by a little more than that. Your trading diary, the calendar for the week ahead looks like this. S&P global PMIs coming at 9:45 Eastern time. Look out for that. Tuesday morning, retail sales. Wednesday, it's the big one. A Fed rate decision at 2 p.m. Eastern time, followed by Chairman Powell's news conference at 2:30. If you're around on Thursday, you'll get some jobless claims and a rate decision from the BOE and BOJ. If you're still around on Friday, you get the core PCE and UMIT consumer sentiment. If you're still there in Europe, I don't know when vacation starts over there.
I think it's already started.
You're focused on the politics. German Chancellor Olaf Scholz awaiting a vote of confidence in Parliament, a vote he expects to lose. Ollie Crook has been covering the story all morning for us out of Berlin. Ollie, what's coming up?
Yeah, so listen, John, we've just had the sort of speech from the Chancellor Olaf Scholz speaking before Parliament that really kicked off proceedings today at 1 p.m., really sort of laying out in many ways his positions for this election, really saying what he wants to do with another term were he to be granted it. And he's really talking about spending, really spending a lot in Germany in terms of infrastructure spend, in terms of getting that spending up on defense. And right now where we are in the actual Bundestag right now as we speak, we have the debate, the 2-hour debate that ensues after that. And then after that, there's going to be a sort of line vote of all the lawmakers in the Bundestag. After that, we will get the outcome. We will likely get a no confidence vote on Chancellor Scholz and this government. That will then allow Scholz to go to the president and to sort of dissolve the government and really pave the way for these elections. You know, Germany, the only country probably in the world where you have snap elections, and it takes almost 4 months to get them done. And that'll be on February the 23rd when you will get that election.
Ollie, just quickly, when does vacation for Christmas begin in Germany? When does that happen?
Listen, yeah, it's going to be at the end of this week. You can see the Christmas tree behind me, as well as some of the protests that have just been unfurled on the Brandenburg Gate.
There we go. I can just about work out what that says. Ollie, thank you. Ollie Crook out of Berlin. The Christmas markets in Germany, Bramo. You know, beautiful. These things start early. Beautiful. Yeah. People fly in for those.
Yeah.
Didn't we hear that from Delta, that they were making more money from those flights?
Yes, that people fly in for the Christmas.
And euro-dollar at 104 is helpful.
I can say, in Switzerland, it starts at 4:30 p.m. on Friday, and everybody immediately goes on vacation.
Some of us are actually working the Christmas week. Just like to throw that out there.
Okay. All right, some of us might check out completely at about 3:30 Eastern time on Wednesday afternoon. I don't know what the show's going to be like Thursday, Friday. I've got no idea. I'll be here.
I think you're going to be here.
Kinda,
So
like physically we'll be present, but mentally might be elsewhere.
That's your promo.
All right, that's the promo for tomorrow too. Mark McCormick at TD, Mike Wilson of Morgan Stanley, Dan Greenhouse of Solace Alternative Asset Management, Amanda Lynham of BlackRock. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the...
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Hi, I'm Laurie Haynes, CEO and co-founder of Shirar, and I'm really excited to tell you that we are going to be raising funds for Shirar again. After a successful raise in 2023, it's time to scale.
We hope that you enjoy the pitch deck and the financial model. Any questions, please don't hesitate to ask us, and we can't wait for you to be part of Shirar.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
Coming up, it's a big week for central banks. We'll get a flurry of decisions with the Fed leading the way on Wednesday. We also have fresh data released this week. It may show that the U.S. economy is humming along. And later this hour, we'll get PMI data followed by retail sales tomorrow. Plus, move over Supermicro because here comes MicroStrategy, the software maker that's heavily invested in Bitcoin, set to join the NASDAQ 100. All that and more coming up, but let's take a look at where markets are trading right now. You can see we're a little bit higher. Of course, the S&P 500 finished lower last week. That is after 3 straight weeks of gains. You can see higher to the tune of about 0.4% right now. You do have big tech leading the action in the pre-market with the NASDAQ 100 up about 0.6% and the bond market. This has been an interesting one. You do have 10-year yields a little bit lower right now, but they rose by 24 basis points last week, Shonali. That was the biggest weekly jump this year.
That's incredible. And you saw that sigh of relief in the market. You are now seeing a hop up on a big week. We're going to talk a little bit more about that. We're going to watch some stocks in particular this morning. Katie was talking about Supermicro Computer, now down almost 12%. It will be removed from the NASDAQ 100 next week, and it will be replaced by MicroStrategy, which has risen more than 500% this year. It has a market value around $100 billion, still on the rise, up about 3.8% pre-market. Also keeping an eye of Capri after a report that the fashion company is working with the bank to find buyers for its Versace and Jimmy Choo brands. You have Capri reacting positively, up more than 4.6% after, of course, its failed deal with Tapestry, Katie.
All right, a lot to keep an eye on there at the single stock level. And this is an interesting one. It is really the last week that matters of 2024, at least from a market's perspective. Of course, we have the Fed on Wednesday, all eyes there, but it's still earnings season. We have Micron, Nike, FedEx coming up all over the next 5 days or so. So it's not over, Shonali.
It's not over. We're going to touch on all of that throughout the week. I know we're going to touch on the retail sector a little later today for those who are interested. Big bid in consumer discretionary. But it's kind of hard to say, Katie, that not all eyes are mostly on the Fed this week. As exciting as a lot of those single stocks are, that macro picture, the dot plot ahead going into 2025 as we posture, I think is going to be the really big story as we close out the year.
Exactly. It's not so much this decision that we're getting this week. We know the Fed's going to cut rates, but what they do in 2025 is an open question. So let's explore some of these themes now, because joining us is Jean Bovin. He is head of BlackRock's Investment Institute. His latest note on the 2025 outlook says, quote, "We think investors should focus more on themes and less on broad asset classes as megaforces reshape whole economies." And I thought this was so interesting, John, because I've been saying for a while that this is a narrative-driven market more than anything else, it feels like. So if you take that approach, sort of that story-led, that narrative-led approach, where does it leave you? What are you focusing on?
Yeah, so the main point here I would start with is that this is not a cycle, right? So we've been spending the whole year thinking about soft or hard landing and the Fed in that context, and we're going to hear this week, of course. But we've been of the view that this is not really the right framing. This is not really about an expansion that can turn into recession. It's rather more about a transformation, big forces that are transforming the economies. And that leaves us, paying attention to the AI team. That's clearly like a big story. We think that there's more opportunity in 2025 there to be generating returns. It's about, geopolitical fragmentation that's going to have implications, energy transition. So these are all these things that will have profound effect across asset classes, but they're not like a cyclical story.
So when I hear transformation, when I hear AI, I think tech, and I think tech stocks in particular. But is that too narrow? Where else can you broaden that to?
Well, it starts there for sure, because we're in the first phase, right? Which is right now to build out this AI capabilities, these factories of intelligence. As we build that out, we need to build it out first before we really get the application. So during the course of 2025, I guess that's going to evolve towards the applications, the phase 2, and trying to get more visibility on where we're going to see the big benefits and the revenue streams out of this. And I think that's where the active management will and the skills will matter more in 2025, whereas now it's mostly about the build out and a few companies.
If you believe in the benefit here, the heft of a few companies, and if you think about the AI promise that many investors have been betting on through the course of this year, what do you then tell investors, Jean, of the people who are betting on the broadening trade? Do you believe in it?
Let me start by saying that the concentration we've seen in the S&P 500 and the markets more generally is kind of a feature of this transformation. It's not necessarily a bug. So I guess the first thing that I would say is that you need to be careful to be reading too much in the concentration as being a red flag. So in fact, we think it's a feature, not a bug, as I said. And eventually we think it's going to broaden out, but that might take some time. So I think not get too nervous about the concentration is the first point, and be on the lookout for broadening out over the course of 2025. But that might not happen overnight.
The NASDAQ 100 alone is looking at gains of almost 30% so far this year. And in your 2025 outlook, you had written that you don't think a pricey U.S. equity valuations alone will trigger a near-term reassessment. So if you're thinking about those risks ahead that would trigger that reassessment, what might those things be?
So we are positive going into 2025 in the broad risk asset performance, and even despite the valuation, as you say, we tend to favor U.S. equities. We've increased our overweight, in fact, to U.S. equities. But what the risk we're going to be watching out for in 2025? I guess there are mainly along two dimensions. The first is, and you've talked about at the top of the hour, the rate repricing. We think rates are likely to go up, long-term rates from here. We don't think the Fed's going to be able to cut much more rates, in the near term. So there's a risk of maybe a more abrupt increase in yields, and that would be disrupting the risk asset and equity. So one thing to watch out is a disorderly, adjustment in rates. And then the second thing is everything that has to do with the tariff landscape and protectionist measure around the world. It's difficult to see an equity market that's going to continue to perform if we have the most bold version of these tariffs being seriously contemplated. So these are the two things we will be watching in 2025.
Well, let's dig into that first point, because Chanel, you were off on Friday, but we had a conversation with Mike Wilson over at Morgan Stanley, and he made the point that one of the biggest risks next year is basically what you're saying, that the Fed can't deliver on what's priced in when it comes to the rate outlook, and that you do see some indigestion, you could call it that, at the long end, but when does it start to hurt from a levels perspective? Because on the 10-year yield, we're hanging out around 4.30. We've seen 4.5. We haven't seen 5% in a while. Where is the pain point?
So we think that like this growth backdrop, this earnings, the fundamentals for equities are pretty strong, and I think it's not about like traditional macro, I guess, as I meant from the beginning. It's really about like this AI transformation, and there's a solid basis. So that gives a room for rates, we think, to adjust upward without fundamentally changing or undermining the equity performance for 2025. So I don't think there's a level per se that's going to be a trigger point. I think it's going to be more about the speed of adjustment. If there's a sudden wake-up call and we think that inflation is much higher than we thought, that the Fed has to stop for a long extended period of time, that in the near term could lead to a more rapid adjustment. So I think it's the speed of the adjustment that would be disrupting in the near term. But I think we can sustain rates moving slowly towards closer to 5% over the next few years and remaining more or less there without ultimately sustained damage to equities.
That concern, oh, sorry, go ahead.
Well, just to draw that point out a little bit more here. So I get what you're saying, that it is the speed of the adjustment. It's not the absolute level necessarily. And if it is AI, for example, and that disruption theme that's sort of driving the action there, in a sense, is that macro proof? Is it insulated from some of the things that we're focusing on here when it comes to the Fed?
I don't think it's macro proof necessarily, and yes, as rates adjust, there's going to be different arithmetic that will need to be accounted for when you think about the project that will need to be financed and the big infrastructure spend. But I think that the size of it, the scale of the build out that is needed, and the opportunity that this is going to create, I think will make that pretty resilient. And unless we have a very abrupt and sustained rate rise, we would think that this is not macro proof, but pretty resilient.
Jean, if you think that you can get to 5% sustainably and you believe that rates could be higher, you're worried about the bond market investing in it right now, what do you think the factors are that would get you there? Is this mostly a result of the government deficits we're seeing and people needing that term premium to be higher at the end of the day? Or do you think that there are real worries about persistent inflation under the surface that need to be accounted for?
I think it's a combination. The first is I would start with the inflation outlook. We've been of the view, for more than a year that this inflation is much more persistent than is hoped for, even by central banks. A lot of the progress we've made was due to mainly two things. One was the post-pandemic normalization and a very favorable immigration story in the labor market. Both of these things will not continue in 2025. And underneath, the protectionism we're seeing and so on, I think there are real inflationary pressures that are going to continue. Not massive inflation, but it's going to be surprising on the upside. That's going to prevent the Fed to really cut rates much more. We never thought this was an easing cycle that was starting, and it's more of a recalibration. I think it's going to become clear as we get into 2025. And then we have the broader story, as you mentioned, around the term premium, which is extremely low compared to the inflation risk we're seeing long term, compared to the deficit trajectory. So these things, I think at some point, there's a bit of a shift in narrative, and it leads to investors requiring a bit more of a higher rates in this environment.
Difficulties in adjusting to that last mile. Jean Boivin, head of BlackRock Investment Institute, we thank you for joining us this Monday morning. Now let's get a look at some of the stocks moving ahead of the opening bell. We're going to bring in for that Abigail Doolittle.
Well, let's take a look and start here, Shernali, with the shares of Broadcom. After last week's big week, we had the best day ever on that good outlook, very good outlook for AI demand. The stock having, again, its best day since 2009, record highs. We have more gains, up 3.1%. A piece of this, just that momentum continuing, investors wanting in on what they're talking about with the massive AI demand, but Bernstein also naming this one of the top chip stocks for the year ahead, plus NVIDIA. Turning to a stock that's trading to the downside, though, we have Tenet Healthcare down a little more than 1% at this point, actually closer to the better part of 2%. This is Goldman Sachs has downgraded shares to a neutral, not because of valuation necessarily. It's stock into today up a very, very healthy 81%, but because of policy uncertainty. So the firm is taking a more cautious view on healthcare providers. They've also cut United Healthcare to a neutral as well. And then finally, Bitcoin last week up for an 8th week in a row. Actually, this week it's up for an 8th week in a row, heading to the longest winning streak on a weekly basis, going all the way back to 2017, above $100,000 per Bitcoin. MicroStrategy being added to the NASDAQ 100. Well, that's put another fire beneath the crypto space. All of these crypto names, Katie, you can see are trading higher.
All right, and what a nice segue, Abigail Doodle. Thank you for that, because coming up, MicroStrategy, as Abby mentioned, getting the thumbs up to join the NASDAQ 100. We'll take a look at all of the changes coming next Monday. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
We spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out. And now to high interest, a look at what's making headlines around the world. China's retail sales growth unexpectedly weakened last month. The slowdown highlights the urgency for Beijing to encourage residents to spend, especially after the re-election of Donald Trump. The threat of a new trade war could diminish the role of exports as a growth driver for China. Meanwhile, Starbucks has hired its first ever chief growth officer in China. Tony Yang is tasked with luring back young coffee drinkers as the U.S. chain sees challenges in its biggest international market. Starbucks was once seen as largely infallible in China, where customers flocked to Western brands, but it has been struggling as cash-strapped diners pull back on pricier drinks in favor of cheaper local upstarts. And the European activist firm Bluebell Capital Partners is shutting down its hedge fund because the size of its fund wasn't large enough to justify the administration costs. Bluebell made a name for itself in investing in European companies like Bayer, Lufthansa, and Danone, where it successfully engineered the removal of its CEO. Not all campaigns were, however, successful. It also called for the ouster of Larry Fink at BlackRock and demanded a shakeup at Richemont, moves that were rebuffed. Bluebell will continue to pursue its activist strategy through co-investments and advisory mandates. Katie.
All right, switching back to the States, let's talk about the NASDAQ 100, scheduled to rebalance next Monday morning. And the bombshell, of course, from Friday night is that MicroStrategy, Palantir, and Axon are set to join the index. Let's take a look now at what's in and what's out with Bloomberg's Bailey Lipschultz. We'll start, of course, with who got the thumbs up, and we have to start with MicroStrategy because this was a bit of a controversial addition, if you want to call it that.
Very hotly debated, Katie, and just to be blunt, this is a company that sells shares and sells convertible debt to go out and buy Bitcoin. The underlying software business loses money. There's a reason that currently it's not eligible for S&P 500 inclusion, which is something that they will address with new accounting rules, potentially to be included, but it's very different relative to the other companies, namely Palantir in the defense tech space, or Axon, which is the company that makes tasers. So very different companies that are being added to the NASDAQ 100, and a lot going on with Michael Saylor and MicroStrategy.
Now, I think it's really interesting to see some of the stats behind this. This is in your world, Katie. MicroStrategy entering the NASDAQ 100. Bloomberg Intelligence expects net buying of $2.1 billion in shares by ETFs to follow, equal to about 20% of the daily volume. But could you get, okay, if you get it into the NASDAQ 100, what are the prospects of it to get into the S&P 500 at some juncture?
Well, the big thing is, so it's currently not eligible for the S&P 500, but because there will be new, this is reading a note from Bernstein, they will, with new financial accounting standard board guidance for the treatment of Bitcoin held on corporate balance sheets in 2025, they could immediately start to position themselves being positive earnings based on if Bitcoin goes up, then they can count that at least on their balance sheet as being positive. But the big question is going forward, how much does this buying impact the stock? And also, do your average investors or your average people who are just putting money in an index fund really want to have exposure to a MicroStrategy?
So I have 2 points here. One is we'll be speaking to Michael Saylor on Wednesday morning, so looking forward to that. Number two is that it's not just, passive buyers who are buying the index. I actually spoke to Tom Lee from Fundstrat last week, and he said to me in his new ETF, he wants to buy MicroStrategy. He will buy MicroStrategy if it's added to the index because they have certain rules that they have to be in an index.
Well, that's the interesting debate when I talk to bankers about IPOs, potentially in the crypto space. Everyone's looking at Circle. If your mandate is to buy stocks, you can't buy IBIT. You can't go out and buy Bitcoin, so you want to buy the next best thing. For certain portfolio managers, MicroStrategy checks that box. But again, the debate and the reason, Katie, going back to the whole discussion going into the announcement on Friday, if your underlying business isn't really tied to actual fundamentals and it's tied to kind of being a proxy for Bitcoin, what does that serve in an ETF?
When we're talking about the companies entering the index and the ones exiting, Supermicro troubles this year have been widely documented.
Amazing story.
Amazing, and the volatility has been incredible. We've also reported here at Bloomberg just a couple of days ago that they're looking to tap Evercore to raise capital. And if you don't have that boost here of all of these passive funds behind you, what happens to other investors you're trying to bring in the door?
Well, that's the big debate, Shonali, and that's kind of another company that's getting the boot in Moderna. You're looking at some of these companies that were very hot, were capturing a lot of excitement, whether you're Supermicro, where your underlying business has kind of had holes poked in it by a number of activist short sellers, or you're Moderna, where you had this big pull forward in vaccine sales, and now you're trying to find the path forward. The big question is, what are your fundamental buyers wanting, and how does the lack of exposure to passive or active in money, just because you're being benchmarked potentially against the NASDAQ 100 or against the S&P 500. If you remove some of these companies, then you have to kind of reconfigure your portfolio. And when you look at some of the companies that get the boot, that's why you see a lot of these kind of plumb new lows.
And I'm glad you brought up Moderna, of course, a real sign of the times when it comes to that stock and just how things have changed so dramatically over the past 4 years. I also want to talk about Palantir, though, in this conversation about this big bid that comes into these names when they're added to these important indexes. Palantir switched specifically to NASDAQ to do this.
Exactly, and that's the whole kind of veiled tweets, whether or not they were kind of confirmed of a member of the management team saying that they were doing it to kind of go to where the attendees are. We do see retail investors flocking to the Qs, which tracks the NASDAQ 100, flocking to some of those levered ETFs that trade in these names. So there is not only kind of that retail play, which we've seen play out with Palantir going back to the meme stock craze, but really continuing to play out with the addition into the NASDAQ 100. And now you have, to your point, Shonali, earlier, you have another box that can be checked for would-be buyers, as well as kind of that passive money that is just going to be being pulled into some of these stocks.
Bailey, we thank you so very much for joining us this morning. A lot going on in the index world. That is Bailey Lipschultz. And coming up on Wednesday, don't miss it. We're going to speak with MicroStrategy Chairman Michael Saylor. That's at 10:30 a.m. Eastern on Wednesday morning. We also have some breaking news crossing the terminal. Canadian Finance Minister Chrystia Freeland announcing on X that she has resigned from her position in the cabinet. Certainly a lot of breaking news, a big moment over in Canada to see their finance minister therefore stepping down. We will bring you more from this breaking news as we get it, keeping an eye on the U.S. Canadian dollar on the move on the heels of that news as well. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week.
More than what you need to know, it's what you need to think about. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Tuesday, Bank of America CEO Brian Moynihan sits down for an interview with Bloomberg's David Weston to discuss the Fed decision Tuesday at 3 p.m. Eastern, only on Bloomberg.
All right, welcome back to Bloomberg Open Interest. Let's take a look at futures right now. We are just minutes away from that opening bell, and we actually have green on the screen. Of course, you can see the S&P 500 up about 0.3%. We're coming off a weekly loss from last week, but there's plenty of catalysts coming up this week from the Fed to earnings. You can see that optimism, too. If you take a look at the NASDAQ 100, up about 0.5% right now. The NASDAQ 100 and your big tech names have been leading this market over the past month. An interesting dynamic there. While we were all paying attention to the rotation trade, maybe it was falling apart. The Russell 2000, also worth a mention here. The small caps, they've been struggling as of late, but the Russell 2000 currently up about 0.1%. It just feels like we're all waiting for Wednesday, though.
You know, the Russell 2000, I've got to say, it's been interesting to see it plateau because you have to wonder how much more of a bid it'll get.
Yeah.
On the year, it's kind of equal to the S&P equal weight, but the S&P 400, for those who have been betting on it, is just a smidge ahead, just a little.
Pick your favorite index. There's a lot of dispersion in this market. Now, coming up, less than 4 minutes to go, we'll discuss the market moves at the opening bell with HSBC's Max Kettner. This is Bloomberg.
offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lyons deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
All right, we are moments away from the start of trading on this Monday morning. This is Bloomberg Open Interest. I'm Katie Greifeld. It's the last week that matters, at least from a trading perspective of 2024. The final full week of trading that we have. And you can see we're starting on a green note, at least if you take a look at what futures are indicating. We had a bit of a downdraft last week when it comes to the S&P 500, when it comes to the Russell 2000. Of course, we'll see if we can turn around the narrative this week. We have the Fed, we have earnings, all of that and more coming up, of course, after what's been a really resplendent 2024, at least at the index level, if you take a look at some of these gains. But let's focus on today's action. Of course, in the first few seconds of trading, you see the S&P 500 higher by about 0.3% right now, fell by about 0.6% last week. So small moves overall as we inch towards the end of 2024. Big tech in charge right now. The Nasdaq 100 up about 0.5% right now. The Russell 2000, a bit of a wipeout last week, falling about 2.6%. Of course, yields were on the rise. That hurt the little guys. The Russell 2000 also feeling some pain this morning, down about 0.1%. Let's look under the hood, though. We're all about those Nasdaq 100 reshufflings, and we start with Super Micro, of course, among the stocks that's being removed from the Nasdaq 100 following the latest rebalancing announcement. You had shares up 28% as of Friday's close, but at least for right now, down about 11% pre-market. Illumina, Moderna also on the chopping block, and you can see investors deciding how to feel about it, Shonali.
Also looking at a few more names here, privy to the NASDAQ. MicroStrategy up more than 4% at the open, added to the NASDAQ 100 next Monday. But the rebalancing, of course, has been announced. MicroStrategy's inclusion may have bullish implications for Bitcoin itself, which continues to hit an all-time high. Palantir, though, down about 0.3%. In the inclusion, Axon, though, up another 1%. Flipping up the board, looking at a deal mover here. Honeywell says it's considering strategic options, including the possible separation of its aerospace business. Remember, last month, activist investor Elliott called for a breakup of its industrial group and one of its largest bets ever. We're going to get a deeper dive into Honeywell with Bloomberg's Abigail Doolittle.
Yeah, shares are performing really quite well, Shonali, up 1.6% this year, hitting a record high, up nearly 10% on the year after Elliott, as you mentioned, did take a $5 billion stake a little more than a month ago, wanting to break out value from the company. So the company now is saying that they are going to do a strategic review. They're considering breaking apart that aerospace business. Elliott has said that they're very pleased, not surprisingly, with the possibility feasibility of this plan. In addition, litigation has been largely settled for this company, removing that sort of a headwind. So again, the stock, this conglomerate that had been sleepy for a while, hitting an all-time high this year, up once again today. As for the competition, though, we're going to see that despite the fact that it is doing quite well on the year with a now 11% gain with today's gain higher, it's underperforming some of the other industrial companies, not quite as large, quite as big as the conglomerate of Honeywell. But nonetheless, this is probably the value, Katie, that Elliott is seeking to unlock in the strategic review. And again, the possibility of that aerospace split, well, investors liking it today.
Yeah, absolutely. Shares currently up about 1.3% when it comes to Honeywell. Abigail Doolittle, thank you. Let's broaden out this conversation now and bring in HSBC Chief Multi-Asset Strategist Max Kettner. Thrilled to have you back with us, Max. And I want to start with the rotation trade, or the lack thereof. It's interesting. This comes, of course, from our markets producer, Dan Curtis, who points out that the Mag 7 is leading the S&P 500 equal weight by the most on a monthly basis since May 2023, which I found a bit surprising. Is this just end of the year kind of funkiness, or do you think that this dynamic will extend into 2025?
No, probably a lot of it is a bit of end of year funkiness, like you called it. I think, look, overall, I don't think there's an awful lot of sort of post-election trade still going on, just like you said, right? We've got the Mag 7. This is not the sort of dynamic we should have expected if it was still a sort of post-election, or if it was still about sort of the election expectations and what's going to come in terms of policy proposals. In fact, I think it has a lot more to do with tech still being pretty good, right? Like guidance of particularly some of the tech behemoths really starting to go up again, and that overall still benefits tech, I think, going into next year. You look at some of the numbers for next year, I still wouldn't really be betting against the Magnificent Seven. Some of the other sectors can catch up, so it's Magnificent Seven and the tech sector and the other stuff, but I don't think it's going to be, okay, we're going to have to buy all this other stuff instead of the Magnificent Seven. What I find remarkable, for example, is when you look at consensus earnings expectations for those 7 names, excluding NVIDIA, so for the remaining 6 ones, it's almost flat year over year for 2025 in terms of consensus earnings expectations. So it's not like we're going into next year and people are super bulled up on the tech sector and on these behemoths. It's really pretty subdued, and that opens the door again for pretty strong earnings surprises, I think.
It's interesting to hear you say this, because I'm looking through your notes, and one of the points you make is that the AI trade is fizzling out a little bit here. But at the same time, you're saying that you can't bet against the Magnificent Seven. So sort of thread those 2 points together for me.
Yeah, absolutely. I think, our outlook for next year still is one of absolute constructiveness. We're going into the first half, and frankly, I'm sort of, I'm sort of stopping at 15 positive catalysts because I'm running out of space on my research notes. But honestly, it's like, it's one after the other where we're going into next year. It's like, oh God, this is another one and another one. So we're really going into next year with a super constructive backdrop, whether that's from the policy side, whether that's, going from the earnings, from the consensus side, whether that's now upgrades to earnings expectations that could be coming into the next couple of months. Obviously we've seen some improvements also in small business and some consumer expectations and sentiment as well. On our measures, also actually sentiment and positioning is nowhere near stretched yet. It's still sort of neutral. Some of the indicators are stretched, but on aggregate, it's still actually pretty neutral. And to the AI trade that you were saying, one thing that we were mentioning where we could be going wrong, aside perhaps from really higher yields, lack of rate cuts and growth going so gangbusters, so in a way that we're too correct in our view going into next year, that really would make basically the market stop pricing any further rate cuts. That to me is still by far the biggest risk. But one other risk is that exactly that AI trade is fizzling out. Perhaps we'll start to see some of the those behemoths surprise to the downside. So look, I'm saying that is a risk. It's nowhere near our base case. Our base case really is the opposite. But we've got to acknowledge that, of course, when we look at, for example, the likes of NVIDIA, an NVIDIA earnings day nowadays is like a PMI, ISM, NFP day combined.
Right. It's a macro event.
Yeah, certainly is. Speaking of NVIDIA, you're looking at 165% gain, and this Philadelphia Semiconductor Index is doing quite healthy, not that healthy, but quite healthy as well with the 23% gain. NASDAQ 100 up around 30%. If you think about the opportunity over the next 12 months for the best 12-month return, where is it going to be? Because even if you're bullish on all of these themes, you've seen quite a run up already, and you have investors scouring the globe for the next set of returns.
Yes, but let's all be honest that when we look at the earnings side, for example, so that's one of the things why we are relentlessly pushing back against this sort of bearish narrative that valuations are too stretched. Number one, valuations don't work on a short-term basis. So when you look at some of those names and people say they're too expensive, it's had this massive run-up like you're saying, well, actually, when we look at the likes of NVIDIA, the PEs have barely changed over the last 2 years, simply because actually earnings have really been continuously delivering, and therefore we've not really seen valuations go through the roof. In fact, and you look at NVIDIA, free cash flow has gone up from what, 5 billion to more than 55 billion. So it's literally gone up 11 times over the last 2 years. So we're seeing such an incredible run up, not only on prices, but really on the underlying fundamentals. So to be honest, like we're going into the next year, I think, particularly the next 6 months, it's a bit of a story of more of the same. It's still tech. There are some other certain sectors, right? There could be stuff like perhaps even on the industrial side, things like perhaps on healthcare, playing the deregulation. I still really like the banks, particularly the large US banks, absolutely. But you won't be able to ignore tech. You won't be able to come around tech. You won't be able to really say, oh yeah, this is done. The Magnificent Seven, we're done with that run, and we've got to rotate entirely out of them. I don't think that's going to work because the fundamentals are so strong.
One of the risks you were talking about, and certainly a lot of investors are starting to bake in, is that kind of higher for longer narrative when it comes to the interest rate story. So what level of rates, how do you think about that number, the golden number at which you start to get worried? Because the market has shrugged off to a large degree the prospect of less rate cuts than expected.
Yeah, I think for the market, it's pretty binary. So for the equity market entirely, it's actually pretty binary, and so it is for spreads. As long as the Fed still keeps cutting, it's still good. So if we're still going to get, hey, 1 or 2 rate cuts, maybe spread out over 6 months, the market can take that, right? We've seen that time and time again in the last sort of year and a half. It's only the time when the market starts pricing in sort of a big wedge in terms of rate hikes. Now, what's the magic number right now? In our models, it's 4.5%. We've got this thing which we call the danger zone, which basically sort of models the level of longer-term and medium-term rate expectations and the level at which basically all asset classes would start to suffer. Not only the S&P, not only equities, but high-yield spreads, emerging market spreads, high beta FX, literally all the asset classes. What we're seeing right now is that level is pretty much almost exactly 4.5%, just like we've seen that a month ago. Remember, a month ago, we had a tiny whiff of that already when we were sort of almost touching the 4.5%, and that was starting to put a bit of pressure on asset classes. Right now, if we're pushing sustainably above the 4.5%, I think that really would bring us a bit into trouble.
We're going to keep an eye on that 4.5% danger zone. HSBC Chief Multi-Asset Strategist Max Kettner, we thank you so much for joining us on what we really see, Katie, as the last week that matters. Now coming up, Dana Telsey joins the show with 15 consumer stocks to watch heading into the new year. It's all about 2025. This is Bloomberg.
So a number of people, I think from Homeland Security and or the CIA or NSA, have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. how much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
All right, welcome back to Bloomberg Open Interest on this Monday morning. Of course, stocks have been open for nearly 15 minutes at this point, and you can see it's green, at least for right now, and at least if you take a look at the S&P 500, up about 0.2%. Of course, we did have a down week last week. We had that big rise in long-end yields that maybe put a dent in the S&P 500, maybe put a dent in the small caps, but the NASDAQ 100 has been where all your strength has been in those big tech names, and you can see that dynamic continuing today with the NASDAQ 100 up about 0.5%. And once again, you do have the small caps starting the week on a down note. The Russell 2000 unchanged, but I mean, the color is red, so I'm going to call that a bit of a downdraft as well, Shonali.
I'm also going to bring in some breaking news here. Of course, we have that PMI data coming in. We have December manufacturing PMI at 48.3 versus 49.7 prior. Therefore, you do see a weakening once again. You see services PMI at 58.5 versus 56.1 last month. Keep an eye on markets here, roughly flat because the trend line is the same. Manufacturing weaker, services stronger. We will keep an eye on these markets, of course, as we get more data coming in. Remember, tomorrow we also get November retail sales data, and we're going to bring this all together now. We're going to talk about the health of the consumer. We're going to talk about the health of retail. We're going to talk to Dana Telsey. She's Telsey Advisory Group CEO, and you have this economy that is telling you a few different things at the same time. We're getting into the end of earnings season. The companies are also giving you this insane bifurcation, if you will. Some of it seems to be a matter of not the macro, but rather of company management, of how companies are navigating the consumer at this part of the cycle, dealing with inflation that is a little bit higher than the Fed's target still. Dana, what do you think that into 2025 investors really need to know about whether the consumer will weaken materially or not?
I think overall we're seeing the consumer being quite resilient, and you're seeing definitely the lower income consumer being very selective on what they're spending on essentials. You're seeing any discretionary spend is going towards items that are new, different, definitely more differentiated than something that they don't have in their closet on the apparel side. And we've seen a moderation in the pace of luxury spending. As you think to 2025, any continuation of lower interest rates would be a benefit for housing and for all of the home-related retailers. The tariffs are something that is a concern. It's expected that in apparel, if you put tariffs and requiring price increases that are nearly double digits, that would constrain some of the apparel sales, while the focus on value continues to remain front and center in 2025.
Well, Dana, let's talk a little bit more about management changes, because it has been a volatile year in the C-suite across industries, but also in retail. And in a recent note, you highlight 15 CEO changes that have occurred recently. And before we get into the specific companies and the different strategies that these new CEOs are sort of pursuing here, what does it say to you that there has been so much turbulence in the C-suite?
I think there has been extensive turbulence in big companies, small companies. I think the pace of change is accelerating. I think the fact that post-COVID, if you haven't improved your business model and you're not seeing an improvement in operating margins, there's got to be a change in what direction the company's going. And therefore, sometimes you're seeing companies bring back old people who had been at the company in order to reinvigorate it. You're seeing people come in from out of the industry to reinvigorate existing businesses, but staying the same, status quo doesn't cut it, because doing the same thing over and over again and expecting a different result is the definition of insanity. So newness, agility, and speed is what's required in order to take a business that has been stagnant and accelerate